Okay, good afternoon and welcome back everyone to our Growth Lab series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay, and this is the first session in a four-part series on why winning trades are not enough to be profitable. And today, what we want to start off with is talking about what profitable trading even looks like. Because as a market strategist over the last 18 years, working with thousands of retail investors, I've noticed a pretty clear pattern with regards to what expectations traders have of profitability. And many times it's actually quite far from reality. And because of that, traders many times focus on the wrong things. And that's why we end up in this cycle of essentially going back and forth through different strategies, different subscription services, and through all of that, failing to reach profitability. So the four-part series that we are embarking on here this today is really designed to help you understand what you need to be focused on and why you need to be focused on it if your goal is to reach profitability. So let's go ahead and get started. But before we do, if you are new to Options Play, you can sign up for a free trial to everything that I will be showing you during this four-part series, as well as giving you access to the recording and slides from today's session so that you can follow along. I posted the link to that to signing up for a free trial in the chat window, or you can point your phone to that QR code here on your screen. And like I said, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. As a market strategist over the last 18 years, these are some of the patterns that I have recognized that contribute to why a lot of traders struggle with reaching profitability in their trading. Now, before we get started, how many of you here watching this session today are in the process of still trying to figure out how to reach profitability in your account? Please type yes into the chat window if that is the position that you find yourself in today, whether you're still learning strategy, whether you are following someone else through a subscription service where they give you trading signals, yet despite your education, despite the subscription services that you are subscribed to, you still feel that you have not reached a point where you can consistently or feel confident that you can have a profitable trading account. And I see a lot of yeses here in the chat window because, that is the pattern that I've noticed here in working with traders over the last 18 years. Some people saying I'm profitable and not enough. Some people are not profitable at all. Some people are really inconsistent in their results. And the thing that I want to start off with is just helping you understand that it's not what you think that's contributing to the underperformance of the portfolio. A lot of users think it's your indicators or who you follow or what data points you have access to. And the reason that I see this or I say that is because of the questions that I get. Everyone asks me, what's the indicator you use? What are the perfect settings of a specific indicator? Who should I follow? How do I get 90% winners? How do I find hot stock picks? How do I find stocks before they start moving? Where do I get more signals? What newsletter should I be subscribed to? Do you have some type of secret strategy that I don't have access to, or you're timing your trades better than I do? And if you are currently in the process of looking or trying to find any of these things, unfortunately, searching for those things will not be the thing that creates consistent profitability in your account. And unfortunately, most traders find that the vast majority of their time trying to focus on these types of things in terms of trying to reach profitability. But arguably, none of these things will help you reach profitability. And for any of you that have spent the better part of your trading career, some of you might have been spending years, maybe even decades, trying to search for the better indicator, the better strategy, the better newsletter, different stock picks. And if you find yourself consistently in this position where you have not reached profitability, I think that's proof that these things are not what's going to provide the trade on profitability. So today, what I really want to focus my attention on is helping you understand what you should be focused on. And it's not your strategy, it's not your indicators, and it's not who you follow. It's the process by which you identify opportunities, and more importantly, how you position for the different opportunities that present themselves. That's going to contribute to your potential for profitability. Okay. So here's the thing is that a lot of traders think that if I just find the right strategy or the right subscription service or the right trading signals, that I'm going to be able to finally achieve a portfolio that looks something like this. Maybe not a straight line, but something along the lines of consistent monthly gains, weekly gains, that will just kind of have this straight line here to the upside. And I can't tell you enough how that does not represent at all what profitable trading looks like. Um, the reality of trading, if you look at any profitable trader's account, you'd be surprised at how long they might go through a period of time where essentially the account is largely flat. They're taking positions all day long, but it could be weeks, many times months of positions that are essentially largely flat. And what you get are small percentage of gains that contribute to a sizable gain in that portfolio. And then you might go through another few months of time. Sometimes, in certain cases, you have traders that may be sideways in their portfolio for upwards of a year, maybe even a little longer than that. A lot of times, I've done a lot of back testing in my life, and especially when you backtest over 10, 20 years and you look at the results of a strategy, you might see that the results of a strategy looks fantastic in the long run, right? And when you look at a chart like this over 20 years, you say, oh yeah, this looks like a really profitable trade, good win percentage, good, gains versus losses, everything. And then when you really dive into it, you recognize that the best strategies have many times long periods of essentially flat performance marked with a few set of trades, usually in the 10 to 15% range of trades that contribute to the vast majority of profits for that specific strategy. So the reality of profitable trading looks very different from what something that looks like this. And everyone seems to be searching for this. And the problem is that if you're searching for this, if you come across a successful strategy, a strategy that works, and a trading system that works, the second you go through a few months of chop or maybe some small losses, and you say, oh, this is not right because I'm not getting this. Well, that's part of why most retail traders struggle to reach profitability. It's not that you haven't found the right system. It's not that you haven't found the right strategy or the right system. It's the fact that the perception of reality is incredibly different than what real profitable trading looks like. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. And here's the thing, right? That's assuming that you have found a decent strategy, and more importantly, you're following that strategy to a plan. Arguably, that's harder to do. It's one thing to find a strategy, to actually trade that strategy and follow the plan exactly is not easy in itself. But even when you do, the realities of that looks very different than what you might be sold, and that many times you go through weeks, sometimes months of essentially just chop, going nowhere, flat. Some days are higher, some days are lower, and that's presuming that you stay incredibly disciplined. But the reality is that we're human beings, and many times we don't stay disciplined. Sometimes we stray from our trading strategy. We know we should be risking X, but sometimes we feel an idea is too good to be passing up, and we actually end up risking 2x, 3x, 5x. And it only takes one or two of opportunities where we deviate from our plan and we slip from our plan to have, instead of these big moves to the upside, we instead have big moves to the downside. And the second you start having big moves to the downside, your chances of having upside are significantly reduced exponentially. And I'm guessing most of you can relate to some level of that, where instead of your account staying flat for a period of time and then seeing a few big wins and flat and a few big wins, you more likely see flat trading for a while and then one big loss, flat trading and then one big loss, flat trading and one big loss. If any of you can relate to that, please type 2 into the chat window. Essentially, the exact opposite of what you should be looking for or what you should be seeing in your account from a profitability perspective, right? So the reality of trading is that a few trades will essentially make your year. A few outsized losers can unmake it, and it just takes a few slips of being disciplined to essentially undo all potential of profitability in your account. And the difference here is not in your strategy. It's not in where you get your ideas from. It's not, your the data that you're subscribed to. It all comes down to behavior. And I cannot stress that enough, that my goal here at Options Play is to help you adjust your behavior so that you get yourself onto the path of profitability. Because without it, you will never get there. No matter what strategy, what indicator, what system you use, if you don't switch your behavior, you'll never get there. I hope that message is clear in what I'll show you today, and I'll give you some numbers to help you better understand just how skewed the reality is from perception. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. So here's the thing. At the entry of every trade looks exactly the same. Meaning, when you enter a trade for the first time, there's nothing in that trade itself that's going to tell you whether or not this trade's going to be a small win, a small loss, or a huge win or a huge loss. Which is why your goal, your job as a trader is to make sure that you stay disciplined across two things. Those are you'll really have to change two behaviors in your account if you want to reach profitability in your account. Number one, you have to survive the ordinary. And the reality is that the vast majority of trades are essentially just ordinary. That's it. They don't really go anywhere. There's small wins, small losses, and many times those small wins and small losses largely net themselves out. And that's going to make up nearly 80% of your trades. And you have to remain disciplined across those 80% of your trades. If you deviate even slightly, if you decide, hey, you know what, this idea looks pretty attractive, or maybe, I heard someone that I really trust on CNBC telling me about this particular trade. So instead of risking, what I normally would risk, I'm going to double the risk or triple the risk because I really, maybe this could really be the big stock pick or the stock pick that's going to make me into a millionaire. So let me size up on this particular trade. It just takes one slip from discipline to essentially unseat your entire year. So number one, you have to survive the ordinary. You have to stick to your trading plan. If you don't stick to your trading plan, one loss, a single loss can take you out from being profitable. The second thing is pressing your winners, or what I call pressing the exceptional. When a trade ends up proving itself to be correct, and like I said, at trade entry, you have no idea which ones are going to be correct and which ones are not. But the ones that do prove themselves to be correct, this is really where the difference between someone who's not consistent, who's not confident in their strategy versus someone who is consistent and profitable and confident in their strategy, the behaviors deviate substantially. because a profitable trader would take that winner and see that as an opportunity to add more exposure. That is when they want to add more exposure, when the trades that they put on have proven to be correct, and now they see an opportunity to hit a home run. And I cannot stress enough how big of a difference pressing home winners makes to an account. And I'll show you some numbers to help you better understand just how skewed the performance is in the few small trades that end up being winners. If you do press those trades, how big of a difference they make to your overall portfolio. And arguably, the second job is the harder one. It's the one that takes is the one that's emotionally more difficult to do. It's the one that's harder to actually to build muscle memory for, because a relatively small percentage of trades fall under this particular category. So you don't get to do it very often. It's not something that's it's incredibly unnatural. It doesn't happen very often, but this is really where most traders that are successful spend most of their time doing the work on, is where they press their winners. The rest of the trades, you just have to stay disciplined. That part, because 80% of your trades require discipline, it's something that you kind of have to do day in and day out. You kind of start building muscle memory pretty quickly on that. But not many of your trades are going to be the ones that take off. And when they do take off, your natural inclination is to take profits and run. But the reality of it is that if you want to reach profitability, those are the ones that you have to do the uncomfortable, which is not take profits, sit on that trade, and more importantly, add more exposure, meaning you risk turning what is a winner back into a loser. That is incredibly painful when that happens. And I think Broadcom is a good example of that, right? We took that opportunity, we got in early, we actually had put on two separate trades. And guess what happens? It ended up being a loss on that particular trade. But if we keep taking shots like this, not every trade is going to end up like Broadcom. Some of them will, and guess what? There's nothing you can do about it, because we don't have a crystal ball. No one has a crystal ball. Uh, you know, Broadcom could have turned into the next Micron. You just don't know which ones are going to turn into Micron and which ones are going to turn to duds. But you have to make sure that you have the fortitude to press that accelerator button when it's uncomfortable, because when you do and it's successful, that's when you're going to hit those home runs, and that's when you're going to see those big gains. The rest of them will end up being trades like Broadcom, which ended up being just like a normal loss, like every other trade. Stay disciplined and press your winners. Does that make sense, everyone? Please type one in the chat window if that makes sense to you. So let's actually break down the numbers, because so far I've kind of um, let's talk about this, because I basically pulled all the performance of all the daily plays that we've been putting out, and here are the numbers. It's skewed so heavily in one direction that this is why, if you don't do this, your chances of being profitable are incredibly small. If you look at all the trades, 21% of all of our trades produced over 95% of our overall profits in the daily play system. Now, for those of you that are new, the daily play are the trading signals that we send out to our members every single day. Every single morning, you get 2 to 3 new trade ideas that we're putting out, and those are the trading signals that I am tracking. We give you stop loss and take profit rules, and when they trigger a stop loss, there should be no ifs or buts. You should cut your losses and move on. Roughly about 30% of our trades, 29% of our trades exactly have hit those stop losses. And your goal, your job is to make sure that you simply cut those losers and you move on. And if you can keep those trades, those losers small, then you can protect your downside, and you have satisfied the first step, which is survive the ordinary. Make sure no single trade blows up your account. So roughly, like I said, about 29% of our trades ended up hitting that stop loss. And then if you looked at 21% of our trades are the ones that produced over 95% of our overall profits. And if you actually break it down, it's only about 10% of initial trades that ended up producing over 95% of our overall profits. So think about that. Only 10% of winners ended up being the ones that ran. Think Micron, think Alphabet, think SanDisk, those types of stocks, Rocket Lab, those types of stocks that really run very quickly. Only 10% of trades end up being big movers. And the reality is that when you enter the trade, you have no idea which ones are going to be that 10%, which is why your goal is to just take on positions, small positions initially, but once those positions prove themselves to be correct, the most important thing to do is to not take profits and run away, which is what your gut tells you to do every single time. If you can relate to that, please type yes into the chat window, where your gut tells you to simply take your winners and move on. And there's this quote that I absolutely hate, which is you can't go broke taking profits. But the reality is that you will not be profitable if you take your profits too early. And that's the reality of it. Because if you looked at kind of the trades of our daily play, those 10% of trades that we ended up adding to, which ended up making up about 21% of the total trades that we made in our daily play portfolio, accounted for nearly 99% of all the total profits we made in the daily play portfolio. Just 15 names, which ended up being a total of 50 trades. So most of these trades that we ended up not only once, but many times adding two more times, sometimes as many as four times on a specific trade, contributed to the vast majority of the net profits of the daily play. The other 79% of the trades netted out to essentially zero. And the only way that they can net out to zero is if you stay disciplined on those 80% of the trades, and then those 10% of the trades that end up being the big moves. You have to have the mental capacity and the mental fortitude to say, okay, I'm going to sit on the profits of my initial trade. I'm not going to take profits right now. And not only that, I'm going to add more exposure to it. And sometimes, or rather, quite a few of the times, it's not going to work out. Broadcom is a good example of that. But more often than not, they will. If you look at Alphabet, that trade alone accounted for $13,000 worth of the $51,000 profit. So one trade accounted for nearly 25% of the total gains in the daily play portfolio, coming from one single trade idea. And at the time, you have no idea that Google is going to be that one trade idea that contributes to 25% of your yearly gains in your portfolio. But that's the reality of trading. So because so few trades are the ones that really contribute to the vast majority of your profits, that is why behavior is so much more important than ideas, because the vast majority of ideas, 80% of the ideas, will end up going nowhere. Only 10% of the trades will go somewhere, and arguably even a smaller percentage of that is what really drives the profitability of your account for the whole year. Does that make sense to you? Please type one into the chat window if that makes sense to you. And everyone thinks that somehow if I just have some secret indicator or some secret strategy that's just going to get me 70, 80% winners. That's just unfortunately not the reality of trading. And if that's what you think, you're unfortunately going to perpetually chase something that doesn't exist, something that's not going to get you to reach profitability. And if you find yourself in that position, I hope that this lesson helps you understand where you should be shifting your focus to, which is your behaviors and how you are managing your trades. How disciplined are you when you trade, when you're entering your trades? How disciplined are you as you think about your winners? So let's take a look at the daily play. Let's take a look at the options play platform, and let's take a look at some opportunities here right now. We recently added some more to the Alphabet trade here. It's pulled back here a little bit, and I think it's an interesting opportunity to take a look at, because the first thing in order for you to even have a shot at profitability is to size your trades appropriately when you first get in. If 80% of your trades are really not going to go anywhere, you better make sure that those 80% of the trades, none of them cause a blow up in your account. And the only way that you can do that is it's incredibly simple. A lot of people think that if you don't blow up your account by getting better ideas or better strategies. That's not how you don't blow up your account. You don't blow up your account by simply sizing your trades appropriately. So we have a tool inside of OptionsPlay called the Risk and Investment Calculator. For every single trade that you make, if you have to click on the Risk and Investment Calculator first to help you calculate the appropriate number of contracts. And it's really important that you use that because and you can set your defaults in your profile. So as you can see here, when you go to the Risk and Investment Calculator, whoops, when you go to the Risk and Investment Calculator, there's a button here at the very bottom. How many of you have already set your defaults in your Risk and Investment Calculator? Please type yes into the chat window if you have already set those defaults, and say no if you have not done this before. Because for all of you that have answered no, I suggest that you right now log into your OptionsPlay account, click on this Risk and Investment Calculator, click on your profile, and enter your portfolio value here. So let's say you have a $250,000 portfolio. I would keep the default at 2%, and that's the 2% rule is really, really important that you use the 2% rule. If you want to be more conservative, you can use a 1% rule. If you have a sizable portfolio, you might even want to start at 1%. But generally, you don't want to go above 2% of total risk on any given trade. That will ensure that you never blow up your account because no matter how bad an idea is, right? Maybe no, even if you made the call to go long Broadcom the day before earnings and the stock ended up dropping 50 bucks, right after earnings, call that a bad idea, whatever you want to call it. You want to make sure even in that particular instance, you don't blow up more than 2% of your account. And the only way to prevent that is not by having better ideas and not having stupid ideas, because guess what? You're going to have good ideas and you're going to have bad ideas. There's no way around that. What is most important is that around every single idea, you have the discipline to control your risk so that no matter where that trade goes, you do not blow up your account. That's first and foremost. If you don't do that, everything else we've discussed is completely moot and will not make any difference if you just end up blowing big holes in your account by not staying disciplined on your trade size. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. So if I save this as default, let's say I have in my accounts 250,000, I'm risking no more than 2%. So if I'm looking at Alphabet, let's say I want to sell a put spread here on Alphabet like we recently did in this particular trade, what I want to do is I want to, as I'm looking at a specific strategy, I always want to click on the risk and investment calculator. In this particular case, 2% of a $250,000 portfolio is $5,000. I click on calculate, and what this will automatically do for me is tell me that I can sell 4 contracts of that July 370, 350 put spread on Alphabet. And this is incredibly important so that you don't have to do any mental math, right? The whole point of this is that the more math you have to do, the more steps that you have to do mentally in your trading process, the more fatigued and the more frustrated you might be by the time you actually place a trade that you will make bad decisions or rather suboptimal decisions. If have you ever found yourself in a position where you've just really struggled to find a trade idea on a given day? Whatever you look at, just nothing quite lines up with what you're looking for. What do? You end up being frustrated by the time you go and place that order. And whenever you make decisions from a place of frustration or a place of fatigue or a place of being tired and you're not mentally clear, those are the times where you sometimes will slip from a discipline perspective and make kind of the wrong choices. I know I've been there myself, where a lot of times where I've just, no matter what, looking for ideas, just nothing quite lines up. And I end up getting frustrated. I get fatigued. And those are the times where I slip and I make bad decisions. And we're all human. We're all susceptible to this. And that is what makes a difference between a retail trader and a professional trader. Because if you do this for a living, guess what? If you go exceed your risk limits, you get fired. There's no ifs or but about that. But in your retail account, if you instead of risking 2%, you decide to risk 5%, there's no one that keeps you accountable for that. That's the difference. A lot of people think professional traders are somehow better traders than you or have access to better strategies than you. They don't. They just are forced to stick to these rules because if they don't, they get fired. And that's how they don't blow up their accounts. And as long as they have, the training and the fortitude to continue to press their winners, that's why professional traders, on average, are far more successful than retail traders. It's not because of their strategy, it's because of the discipline that's enforced on them through their employer. If they don't do it, they wouldn't have a job as a trader. So, most important thing is that when you trade something on options play, you use the risk and investment calculator every single time. It takes the math away from you. It automatically calculates for you so that you can focus your attention on making better decisions for your portfolio. Does that make sense? Please type two into the chat window if that makes sense to you. So step one, define the risk. Make sure that you kind of you trade strategies where you understand the maximum risk of a trade and know the max loss based on the trade structure and size your trades appropriately. Position your size so that no trade will create a setback for your overall portfolio. And uh, I can't tell you enough. There are lots of ideas out there. Trade as many of them as you possibly can because, only 10% of them will end up being the ones that provide the outsized profits for your account. The only way to reach those 10% is you got to take on some risk. And but as long as each one that you take is small initially, that is the key to it so that most of your trades end up being washes, some small wins, some small losses. That's going to be the majority of trading. It's a bit of a slog, It's not trading is not all sexy. Not trading is not like, oh, if you just find some secret indicator, some secret strategy, you're just going to turn out profits day in and day out. That's just not reality. And if that's what you're chasing, unfortunately, you'll be chasing that forever and never reaching it. The reality of trading is that the vast majority of your trades are going to be quite boring. They're going to be small wins, small losses. Only about 10% of the trades are going to be ones that really take off. And you better be prepared mentally for those trades that do take off and not take profits early and have the mental fortitude to press those winners. And that is what we do here in the daily play. Um, so if you look at kind of the daily play process, right? We continue to press new winners. Broadcom is a good example of that. We entered it before it took off. We entered it as soon as it started to take off. And that's why, at this stage, our Broadcom position is not down, hasn't blown 5-6% of our portfolio, even though we risk on a total of 6% of our portfolio on that one trade. We're only down about a little over 1.5%, one point, maybe 1.75% of our portfolio on that trade because we got in early and we pressed that trade early. The only way you can do that, the only way you can survive that is if as soon as a trade proves itself to be a winner, you want to continue adding to that position. Alphabet's a good example of this. We started adding to Alphabet back in we started adding to Alphabet. I know at around on April 17th when it was trading at 336, we added to that, and then we added more to it when it was trading at 345, and we added more to that around it was I think 380 or so. It's pulled back a little bit, but we'll continue adding to it because if you look at the overall trades, they end up being profit. The thesis is still intact, so we'll continue to adding to this position. We last added it when it was at 376. So that last trade is a little bit underwater, but the three trades added together add up to roughly $13,000 worth of profits. Like I said, Alphabet in itself makes up nearly a quarter of our total profits for the daily play over the last, I think, roughly 6 weeks or so. So, and there are so many examples of this. So it's one thing to teach it to you, it's another thing to actually show you how to implement it. And that's really what we do here with the daily play. So if you follow along with our daily play, specifically read the thesis. It's only a couple of lines. With every single trade idea, I write those a couple of lines, and I specifically only write a couple of lines so that you don't have to read 7 paragraphs as to why I'm bullish on Alphabet or a specific stock. And I will always mention to you if this is adding to an existing winning position. I made it very clear in the Broadcom trades. I made it very clear in the Alphabet trades that we added to earlier this week. What are some of the other trades that we added to recently? Oracle's another one that we just added to earlier this week, right? These are winning trades that we're adding to it. And I explicitly tell you that in the thesis of the daily plays. So not only am I trying to teach you this process, I'm trying to help you build that muscle memory on a daily basis. And that's a journey that we're on here together here at Options Play. I hope that if you are currently a member, this is the value that I want you to be able to get from Options Play. It's not just access to the platform or the trade ideas, but helping you change your behaviors so that you have a shot at reaching profitability in your account. So with that, what I wanted to kind of just reiterate today, we're focusing on kind of the math behind it and what you really should be focused on because, like I said, the vast majority of traders I find are simply focused on the wrong thing. They're trying to find the right strategy. They're trying to find the right signal surface. They somehow think that if I just get the right subscription and buy the right data and access the right indicators, I'm going to be successful. Those are kind of you need those things, but those are not the things that are going to make you successful. Next week, we're going to talk about risk control. The week after, we're going to talk about that winner management. Actually, how do you actually incorporate what I'm showing you here on the loss side and more importantly, on the winning side? And then lastly, we'll look at kind of we'll review the rules and more importantly, look at some more trades together and show you opportunities. So next week we'll review some of the losing trades, how we got into it, when we got out, how to stay disciplined on the downside. And the following we'll actually look at the winning trades, which is arguably the harder thing to do, at least mentally and emotionally. Adding to winning positions is the hardest thing to learn, and you don't get to do it very often. So it's not something you can build muscle memory on a daily basis. So it's really something that we spend quite a bit of time trying to teach. So some homework here for you for next week. I want you to try to go into your brokerage account and take a look at your trade history. Pull out the net last 20 to 30 trades, which is going to be a sample size, large enough to kind of start getting some insights into what your behaviors are. And take a look at kind of what your win rate is, what your average win, average loss is, what's your biggest win or biggest loss, and what's your win to loss ratio. And get a sense for what are your top 3 trades and what percentage of your profits did those 3 trades make? Because that's going to help give you a better understanding as to what your behavior looks like today. Because unless you can understand what your behaviors are, it's going to be difficult to figure out what you need to fix. So the first thing that you have to do is really take a hard look at what you're doing today in order to help you put you onto the path of profitability. But that is my goal with these Growth Lab series. That is my goal here at Options Play, and everything that we do is to help support that. And I do want to just let everyone know here, on the Monday and Thursday equity research reports, like the one that you received this morning, we send out the stocks that are breaking out early, the stocks that are in that confirmed leadership list. We now publish that every single day inside of Options Play. So if you go to your watch list on Options Play, all the stocks that are in that early breakout category here, you can see directly here on Options Play. So these are the ones that we highlighted in our equity research report here today. These are the ones that you might want to take a look at, and these are published every single day going forward. So you don't have to wait for our Monday and Thursday equity research report. You can find these trading opportunities yourself inside of Options Play. You can find the breakouts, the outperform stocks. You can find the underperforming stocks. You have all overvalued and undervalued stocks here as well. And I've recently updated upcoming earnings as well, so that you kind of always get what's reporting earnings that's upcoming right now. So obviously, Broadcom and CrowdStrike just reported, but we do have Lululemon coming up. You have, there's the earnings season is pretty light here at the moment, so there's not a whole lot at the moment. But that's really some of the updates that we're making to our platform so that you can get these trading signals on a daily basis as opposed to having to wait for our Monday and Thursday equity research. Um, with that, that covers what I wanted to share with you here today. And just a reminder, if you are new to Options Play and you want access to the platform that I just showed you here today, or if you want access to the slides or these recordings, sign up for your free trial at optionsplay.com/registration, or you can point your phone to that QR code. I'll put that link in the chat window, and I'll leave this up. So if you want to point your phone to that QR code, you can sign up. Okay, good afternoon and welcome back everyone to our options education webinar series on why winning trades are not enough. This is the second part of our series, which is really focused on how to reach profitability and why just getting win rates is not enough to reach profitability. Most of us struggle with this in some way, shape, or form. But before we can really get to talking about upside, before we can talk about how to reach profitability, the first and foremost important thing to understand is how to protect downside. And this is probably one of the most overlooked aspects of trading. And in my 18 years of working as a market strategist with thousands of retail and institutional traders over that time, this is really the one area where there's not a lot of visibility put onto it. Everyone talked about indicators, strategy, fundamental analysis, technical analysis, option strategies, but not a lot of emphasis is put on risk management. Yet, arguably, this is the most important part of how to reach profitability. Because in order to reach profitability, you have to be able to protect downside. And that's what I want to walk through today's session. Now, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and over the last 18 years, I've spent my time working with, like I said, thousands of retail and institutional investors over that period of time to help them understand market color, strategy, and most importantly, how to reach profitability with their trading. So, like I said, this is part two of a four-part series. Now, if you've missed last week's session, I highly recommend that you go back and watch that recording because we really laid the groundwork for what we're going to cover during this four-part series last week to help you better understand what are the behavioral modifications that you have to make if you want to be successful at trading, and more importantly, why. So, today, what we're going to focus on is the first aspect of that, which is downside protection. Because in order for you to have any shot of profitability, the only way you can get there is if you make sure that you can protect your downside. Like I said, this is the one area where most commonly overlooked by traders. In my experience working with traders, they always want to talk about strategy. They always want to talk about technical indicators. They want to talk about what specific ways that I am using um, uh, people want to understand what specific ways of option strategies or technical analysis I'm using. I rarely get the question around how do I protect downside. But if I look at what makes the difference between a professional trader and everyone else, this is the one aspect where there is a very clear black and white difference between a professional trader and everyone else. Versus if you look at just every other part of your option strategy, there's a ton of overlap between a professional trader and a retail trader. So, let's go ahead and get started. Now, before we do, if you are new to Options Play, you can find out more about what I'm going to show you during today's session at new.optionsplay.com/registration, or you can point your phone to that QR code. Both of them will give you access to the the tools that I'll be showing you during today's session. So I'll post that link here into the chat window for those of you that want to sign up for an Options Play free trial. Otherwise, you can point your phone to the QR code on your screen, and that will give you access to the tools that we'll be using during today's session. Here at Options Play, our focus is on helping you build a process that's driven by profitability. That's our goal here, is to teach you a process for how you take ideas from just about anywhere. Ultimately, we all get ideas from lots of different places, whether it's TV or social media or our own strategies. How do we turn those ideas into profitability? That is at the core of what we are driven to do here at Options Play. That is what these Growth Lab series that we host every single Thursday are focused around. On top of the trade ideas that we do provide and some of the specific ideas that are relevant to helping you achieve the behavioral modifications that are required to reach profitability. And at the core of that is the early breakout detector, which we will talk about here during the series later on in the series here at Options Play. So that is all part of your Options Play subscription with the Growth Lab series. So let's talk a little bit about downside, because it all starts with it all starts with what you prioritize as important when it comes to trading. And over the years, one of the things that I've realized is that most traders are thinking about trading just from the wrong perspective. And when you think about it from the wrong perspective, it's not hard to understand why we focus on the wrong things when it comes to trading. And this is probably best summarized by a theory or a concept written by a NYU professor back in the 80s. He wrote a book called Finite versus Infinite Games. And he was a religious philosopher. He wasn't a finance professor or anything like that. But he wrote this book called Finite versus Infinite Games. And he theorized that there's two types of games out there. There are finite and infinite games. Finite games are ones that we are all familiar with, where there are fixed rules and there is a clear goal at the end, which is to win that game. And based on the rules of the game, you declare a winner and a loser at the end of the game. And when you're playing a finite game, the goal of that game is to win. And examples of this are chess, football, basketball, games that we're all familiar with, where you do everything you can to win at that game within the bounds of the rules. However, he theorizes there's another type of game called finite, infinite games. And when you think about infinite games, there is no fixed end to an infinite game. There's no fixed rules to an infinite game. There are only players and dropouts, meaning you either have enough resources and capital to continue playing, or you have essentially exhausted your resources and you cannot continue and you drop out of the specific game. In this particular case, the goal, there is no such thing as winning in such infinite game. The only goal is to keep playing. And a good example of this is running a business, your particular career. You can even relate it to your marriage. You can't win at any of those specific games. The only thing you can do is either have the resources to continue on or drop out. And when you think about playing an infinite game, the rules, or rather the goals, are vastly different. And it's important that for everything that you do in life, you evaluate, am I playing a finite or infinite game? And when you think about trading, we always think about trading as wins and losses. So it's very easy to put ourselves into the peg of, I want to win as often as possible, or my focus is on winning in trading, and I want to not lose. So we psychologically put ourselves into the same category as of when we're playing football or chess or any other game where the goal is to win. But when you really realize it, there's no such thing as winning when it comes to trading. Either you have enough capital to continue trading another day, or you've blown up your account and you have essentially are forced to drop out of trading. And when you realize this, that's really where something can potentially shift in your head, and you realize that you can't win at trading. Your only goal is to stay in. And when your only goal is to stay in, the most important thing is to protect your downside, protect your ability to stay in the game at least one more day. And your only job is to make sure that you survive another day. That's it. That's your only goal. And this is really an important thing to understand when it comes to trading, because once you realize this, your focus completely shifts, and your mindset just completely shifts, and you stop focusing so much on strategy indicators, who you follow, what news sources you are subscribed to, what subscription services you have access to, and you start focusing on looking at your account size, looking at every single trade you make, the size of each specific trade, and how much you have at risk. Meaning, um, if let's say the markets fall by another 20% over the next few weeks, what does your portfolio look like? How do you protect yourself if that were to happen? Even if the worst case scenario happens, how does your portfolio look? Does your portfolio go down to zero? Does it go into the negative, or do you still survive another day? And you realize that that's not where that's where it all starts. Without it, there's no upside in trading at all. So this is really where the most important thing is, to start with making sure that every single trade you make ensures that you survive another day. How do you do this? Well, this is really where we turn to math, because it's fairly straightforward. It's the method for surviving is incredibly simple. It's the mindset, it's the focus that we have to shift in order to change our behaviors. So this is really where human beings, unfortunately, we're incredibly bad or at estimating exponential curves. And unfortunately, losses and the gains that are required to get back from a loss grows at an exponential pace. And this is something that we are, as human beings, are bad at estimating that exponential curve. So the math part that we have to understand is what we call the recovery tax. How much do you need to gain back from a previous loss? If you have an account that has declined in 10% in value, you need an 11% gain to get yourself back to break even. So lose 10%, you got to gain 11 to get back. But on the other hand, if you were to lose 25%, you have to gain 33% back. So you have to gain significantly more back just to get yourself back break even if you lose 25% versus 10%. Now, if you go a little bit more, if you lose 50% of your premium, I'm sorry, 50% of your account size, you need 100% gain just to get yourself back. So you're not losing much more each time, but the amount that you need to get back to break even becomes exponentially harder. And this is why, generally speaking, if your account were to draw down past 20 to 25 to 30%, the gains that you need are so large to get back to break even, they become pretty hard to do. Meaning once you lose that 30% and you need, roughly a 50% gain to get back, it's pretty hard to get yourself back without depositing more money into your trading account. Which is why, at all cost, our goal is to try to not get past that 25 to 30% drawdown threshold in our account. Because once we get past that threshold, the gains that are required to get back grow at an exponential pace. And once it goes exponential, this is really where we lose the grasp of how the math really works. So this is arguably, one of the most important thresholds to make sure that you stay within from a trading perspective. And if that's the threshold that you have to stay within, the questions is how do you get there is pretty straightforward. The best way to do that is to simply stay small on each individual trade. Most of you have probably heard of this rule or something similar to this, where you don't want to risk more than 2% of your total account value per trade. Risking 2% of your account value per trade gives you the flexibility of having as many as 10 consecutive losing trades in a row and still being able to survive that. 10 consecutive losing trades in a row is a significant losing streak. And even in that significant losing streak, you have the mathematical chances of coming back and surviving and continuing as a trader. Because if you can't continue as a trader, you've essentially are out of the game, right? So if you, let's say you were to risk 5% of your account per trade to go through that same 10 consecutive losing trades, you need 20 winning trades just to break even. So you're risking you have the same number of consecutive losses, but in one scenario, you need 13 winning trades to get back to break even. That's not easy to do, but potentially not insurmountable. But to have 20 winning trades in a row to get back to break even, that I would say is mathematically nearly impossible. So, the same scenario, same trades. The only difference is what percentage of your account you're risking per trade. Now, I'm going to pause there for 1 second. Does that make sense to everyone? Please type one into the chat window if that makes sense to you. Perfect. So this is really where I want to take a pause here and take a look at the OptionsPlay platform because I want to show you the tool that's built into OptionsPlay that forces this rule onto your trading every single time. And that you can set up inside of your profile. So if you go to your profile, which is the hamburger menu on the upper right-hand corner, and you click on your profile section on the very top, there is an um, risk and income settings here at the bottom in your menu. And within that menu, we have a thing called the portfolio risk setting, which is a contract calculator. And what this allows you to do is to input your portfolio's value. So let's say you have a $100,000 portfolio. You can enter that into your portfolio calculator. It'll automatically default to the 2% rule. I say that for most traders, you can start with 2%. If you are the type of trader where you like to enter a lot of different trades, maybe you want to reduce that to 1%, but you generally don't want to exceed 2%. The only time that I see traders exceed this 2% rule is if you're working with an unusually small account. So meaning you have an account that's maybe $2,000 or so. It's really hard to risk 2% of $2,000. You really are forced to use a slightly bigger percentage of your account because each option contract is just going to unfortunately take a larger percentage of your account. Now, you're forced to do that when you're working with such a small account, but generally speaking, the rule of thumb is to try to work your way up to an account size where you can risk 2% of your account per trade. Because like I showed you, once you get to that 5% range, you can easily exceed that threshold fairly easily and get to a point where it's virtually impossible to get yourself back to break even, which is why you can work with small accounts. And if you are working with small accounts, you really have to be incredibly diligent in terms of risk management, meaning managing stop losses when you should, and then also staying on top of your trades. You also have to adjust your strategies to work with strategies that are more suitable for small accounts. That's for a different day, but 2% is where you want to set this. Now, once you make these settings inside of OptionsPlay, anything you're looking at within options play, you can click on the risk and investment calculator. It'll click on calculate and it will calculate the appropriate number of contracts that you can trade to stay within your risk tolerance. So I must have forgotten to save this and I was still stuck on the $250,000 portfolio. So here with $5,000 that I can risk per trade, this will risk $3,884, which is two contracts. Now, here's the thing, right? In this particular case, if I did trade three contracts, you can see I'm at $5,826, which exceeds my $5,000 threshold. Well, sometimes you might find yourself where if you trade two contracts, you're maybe $3,500. You trade three contracts, you're just above $5,000. You can, it's not that you can't go over by a few dollars. You certainly can, right? So if let's say you're at 2.1% or 2.2% of your account value, that's acceptable, especially since there is some variation from trade to trade. Some of them might take 1.8% of your portfolio, other might want to be 2.2, but you generally want to make sure that you're in that range. So you have some flexibility, but the rule of thumb here is that you can use a tool like this, which can essentially help you identify exactly how many contracts you can trade. So for example, if I'm looking at Airbnb and I'm looking at a bearish trade here, let's say I want to buy this August 130 put, every single time I can just go to risk and investment calculator. I click on that button once, it'll automatically calculate for me that I can buy five contracts of these particular puts. And the max risk is $4,740, which is within my $5,000 limit. It's really, really simple to stay within this specific rule. It's one click. It should not take any effort on you. It doesn't really drain any mental capital. There's a lot of other parts of trading that drains you mentally. And, that mental capital sometimes is what prevents us from making some of the best decisions. But this is arguably the most important decision. And this is one that really should not take any mental capacity to do because it's something that you do before you get into a trade, right? You're not seeing live P&L tick where things kind of, because once live P&L starts to tick, different emotions take over that sometimes prevent us from making the best decisions. But this is before you get into a trade. That hasn't started yet. That adrenaline of the P&L hasn't started yet. So this is really where you should be able to make clear judgment calls on every single trade. And this just requires a bit of muscle memory. This is a habit that you should form before every single trade. And the tools within Options Play will help you do that so that every single trade that you make, you stay within that $5,000 limit or the 2% limit of your account value. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. And if you are doing that, if you have an Options Play account, I highly recommend that you go into your settings right now, go to your profile, go to that risk and income settings. It takes literally 2 seconds to enter it once. Go in there, put in those settings so that the next time you evaluate any trade, you have the risk and investment calculator already set up for you to click on calculate and calculate the appropriate number of contracts for your account. Okay? So let's switch back to what we were discussing here. And this goes back to um, the single most defining difference between a retail and professional trader. Like I said, I've worked in this industry for 18 years and I've worked with thousands of traders. And there's really only one aspect that professional traders differ from you. A lot of people think that, professional traders, they have access to better data. They've got their Bloomberg terminal. They've got some secret strategy that they've been honing for the last 20 years that I don't have access to. That's why they're profitable and I'm not. Well, I can't stress enough that none of those statements, generally speaking, are true. Especially these days where retail traders many times have better access to data than professional traders. When I work with advisors, when I work with folks on the buy side, or the tools that they have access to, many times are not better than what retail traders have access to, and I've actually seen that many times. professionals actually have access to less tools because they are only given the tools within the bounds of their employer. They don't necessarily have the full scope of all the things that a retail trader has access to. But there is one part that is very different between a professional trader and a retail trader, and that comes down to risk management. Because when you work for a hedge fund, when you work for a buy side, when you work for a proprietary trading shop, those risk limits are put upon you as arguably the only rules for your trading. If let's say you're a hedge fund trader and you're a trader at a prop desk, really there's no rules around what strategy you have to trade. The only rule that's put on you is how much you're allowed to risk. And if you ever exceed those risk limits, you're fired. That's why professional traders don't blow up their accounts. It's not because they're better traders than you. It's just because they're forced to stay within a 2% rule or a 5% rule or whatever rule their employer puts upon them. And if they don't follow it, they're fired. They no longer are a professional trader. That's the biggest difference between you and a professional trader. Everything else is in many aspects identical between a retail trader and a professional trader. So remember that. If you think that you're not succeeding because you don't have access to a Bloomberg terminal or you don't have access to the right indicators or you haven't back tested your strategy enough, I can't stress enough how those are not the things that are contributing to a lack of profitability. Most of it comes down to the fact that as a retail trader, discipline is essentially optional. The risk limits that are placed upon a professional trader are 100% optional. Most of you may not even know of, have never even thought about risk limits of your portfolio. So, especially when you're under stress, all of those go out the door. Even if you have the best intentions and you know that you should be maintaining risk limits, the reality is that once you're placed under stress from a winning or losing trade and you're seeing the live P&L take in your account, those rules go out the door because there's no one enforcing it. No one's forcing you to take on these risk limits. So you can easily size up uh, you can easily size up, too much on a specific trade because you get really excited about a specific trade, something maybe you saw something on TV or someone, that you follow or someone that you trust told you about an idea. So you, instead of risking 2% of your account, you risk 10% of your account on a trade without really even thinking through what the ramifications of that are. Well, that's really what contributes to losses because no single idea is better than the other, and when you exceed your risk limits, that's when you blow up your accounts, and that's when you have really no shot at being successful at trading. If you can relate to what I'm telling you, please type yes into the chat window where you have the best intentions of following the rules, but as soon as the emotions from trading take over, that kind of goes out the door. No one's here to yell at you or force you or to stay within their risk bounds. So the only person that's there to keep yourself honest is you. And half the time, we're not even aware of what we need to be focused on. So my goal today is to number one is to make sure that you understand what your focus should be on. Because once you can recognize that, the ability to do it and the process for doing it is incredibly straightforward and incredibly simple. And it's not one of those, significantly uh, mentally tough things to overcome, like what we're going to cover next week. What we're going to cover next week requires a lot more digging deep within kind of our mental capacity to actually implement. What I'm discussing with you today is arguably the easiest part because it's the part that you determine before you get into a trade, before the adrenaline rushes in and the emotions come, and when we prevent ourselves from making the right decisions. Sizing a trade before you get into it should be arguably the easiest part to accomplish. And it's arguably the most important part to keep you in the game so that you have the opportunity of capturing that upside. Because if you don't protect your downside, no matter what opportunities comes your way, you won't be able to have those opportunities outweigh your losing trades, which means that you won't be profitable, which is the goal that we have here during these Growth Lab series, is to help you understand what process you need to put in place if your goal is to achieve profitability, which I'm sure every single one of you watching has that exact same goal. So, a little glimpse into what we're going to cover next week um, once we establish what we discussed here today, which is protecting downside, is understanding once you protect downside, how do you actually reach profitability, right? Just because just by protecting downside, that you're not going to be profitable from doing that, right? It is certainly the first step towards profitability, but just by protecting downside, you're not going to be profitable from just protecting downside. What I want to introduce to you next week, which we're going to spend the entire session on, is to understand how you can essentially take what are fairly ordinary picks in the market and turn it into a strategy that is profitable for your account. And we discussed this a little bit last week, which is how you can turn, if you look at the daily plays that we publish every single day, we have about a 56% win rate in terms of the individual picks themselves, which is a fairly ordinary win rate when it comes to the market, when it comes to trading. I will say, a lot of people think that somehow if you just have a better strategy, you have some better indicators, you'll have 80% winners, or you'll be able to pick 80% of the stocks that you pick will be successful. I couldn't tell you how far away from the truth that is, because even some of the best traders have maybe about 60% winners. That's usually the top end of the range in terms of what type of directional picks you can make in the markets, is around 60% is the top end of the range. And I have done thousands of strategies backtest over my 18-year career. And I can tell you with a high degree of confidence that the best strategies, the best technical strategies, maybe reach about 60% win rates. And once you get to that 60% threshold, you're talking about strategies that give off very few signals. If you want any type of strategy that is going to give you signals on a fairly daily or weekly basis, you're going to be in the 56 to 80% range at the high end. So if you look at our daily play picks, we had about a 50%, 56% win rate. Yet with that, we were able to outperform the S&P 500 by sorry, 2.6 times the S&P over the period of time using the strategy that I'll be discussing with you next week. So the first step is protecting downside. And once you protect downside, then you can have the ability to focus on that upside. And more importantly, that upside is not about your strategy. It's not about your indicators. It's not about some secret thing that professional traders have access to that you don't. It's all about the process that you follow to take winning trades and turn those winners potentially into home runs. And when you follow that process alongside with what we went over today, you can see results that are outperforming the markets, even though you have, stock picks of about a 56% win rate. A lot of people think that you need to, be able to pick stocks with a 70, 80% accuracy if you want to be profitable. That couldn't be further from the truth. And this is really where the it's important to discuss what process you need to reach profitability. It's also important to highlight what the reality of profitable trading looks like, because a lot of people have been sold this reality that somehow if you just have the right indicators and the right strategy, you're just going to have 80% winners and you're going to be printing money left and right. That's just not how trading works. If you look at any profitable traders' accounts, that is far from the truth with regards to how to actually achieve that. So that's what we're going to discuss here a little bit next week, is the process over prediction. A lot of people think that you have to get better at predicting the markets, and that's just not the truth. It's really the process that you apply to the trade ideas that you have that will help you reach profitability. But that is not even up for discussion if you can't protect your downside first, which is why first and foremost, you have to protect your downside. Once you do that, we can talk about the upside. So some work for next week, or rather summarizing what we discussed today. Number one, you definitely need to set a stop, meaning for every trade that you get in, you have to understand at what point does this trade not is not at what point would I say this trade is not working out? So for example, if let's say you're getting into a trade as a result of a technical indicator or a technical level or something related to the chart, then you need to understand based on that strategy, at what point does this trade setup not working out? And this is something that you should be able to note to yourself and reference back as as the trade is working or against you, because when the P&L starts to tick, that's really where relying on our mental acuity to make the right decisions will be a process that won't be particularly successful. Versus if you were able to write something down, something concrete, something that's subjective and not objective, to say if the stock goes below a specific level, or if this indicator crosses this threshold, or if something that's objective that you can read on a chart happens, then my thesis is no longer correct. If you can write that down, then as the trade ages, you can ask yourself, has this crossed this specific threshold or not? If it hasn't, great, you can stay in the trade. But as soon as it crosses that threshold, you should be considering getting yourself out and moving on to the next trade. So setting some type of a stop on this specific trade will help you protect your capital so that you never stay in a losing trade longer than you should and risk more money than you need to on a specific trade. That is a discipline that you need to start to build. The second thing is sizing your trades to 2%. You'll find step one to be a lot simpler if you size your trades correctly. Meaning, if let's say you are trading your relatively small size to your portfolio, you're going to find it much easier to follow these rules. It's when we trade too big of a size, that's when we have a tough time accepting a loss and moving on, right? So if let's say you risk 10% of your account on a trade and it doesn't work out, we become what poker traders call pot committed. I mean, we've just committed so much money that we can't afford to lose. So when it comes time to admit that the trade's not working out, we don't want to admit it. We instead hold and we hope. We hope that maybe it'll come back tomorrow or the day after, so that we don't have to be forced to take on this loss today. And that leads to unfortunately, the demise of a lot of trading accounts is when we trade too big and we can't commit to accepting the fact that the trade hasn't worked out the way we expect it to. If you can relate to that, please type one into the chat window. If you've become pot committed to certain trades, where you just are forced to stay in it because you risk too much. You can't afford to lose it. So you just hold and you hope. And many times by doing that, you actually lose more, by holding and hoping. And third, cutting a trade at the stop loss level that you've determined. And that also should be very black and white, because either the position has crossed that stop loss level or it hasn't. All three rules are designed to protect your downside. And if you can start applying these rules to your account every single time, it becomes muscle memory. It's something that doesn't require a lot of mental capital, because all three rules are completely objective. There's no subjectivity in this at all. There should not be any subjectivity, because once you introduce subjectivity, that requires mental capital to determine, should I, has it reached a point where it's no longer valid or not? And then you have to burn energy cycles to figure that out every single time. That's when we start making bad decisions. But if you have very black and white rules every single time you get into a trade as to where my stop loss levels are, where does the trade need to go? And at that point, I would say, this trade's not working out. If you can write those rules and kind of clear black and white rules, it's an easy decision every single day. Has it crossed that threshold or not? If it hasn't, I can stay in the trade. If it has, I need to get out of the trade. And the decisions to cut losing trades, you want to reduce as much mental load as possible on that so that you can focus on what we're going to discuss here next week, which is your winning trades. That is where you reach profitability. Today is where you prevent yourself from uh, being at a stage where you can where you can have a profitable trading account. But next week we're going to talk about how you actually reach profitability by focusing on your winners. And you want to make sure that you retain your mental capital for that, because managing winners takes a lot more mental effort. There's a lot more subjectivity involved in that versus the downside is very objective. And there should not be a lot of mental capital expended on managing losing positions. Yet, in my experience working with traders, they spend the vast majority of their time focusing on their losing trades and not nearly enough time on their winning trades. They're constantly looking at their losing trades, saying, what can I do to fix this losing trade? When in reality, the thing that they should be focusing on is cutting their losers and focusing on their winners. And if you can relate to saying, if you can relate to the fact that you probably spend a lot more time looking at your losing trades, please type two into the chat window versus looking at your winning trades. It's not uncommon that we ruminate over losing trades and say, what if I could just turn this losing trade back into a winning trade? That will be what, how I become a successful trader. I can't tell you enough how your losing trades should be the thing that consumes the least amount of your energy, because the winning side is where it's going to take a lot of your mental capacity, and you want to make sure you have a clear head for that. So if you spend all your time and your mental energy focusing on your losers, you will not be making good decisions on your winners, and you really, in that two-part combination is, I would say, 80% of why most traders struggle to reach profitability in their trading account. Because by focusing all your time on your losers, what happens is your losses are bigger than they should. And by not spending enough time on your winners, you severely underperform. You take profits too early. So on one end, your losers are bigger than you want it to be, and on the other end, your winners are smaller than you want it to be. And that combination of the two with each other is what contributes to, I would say, at least 80% of traders that quote unquote struggle with profitability. When in reality, if you don't focus too much time on your losers and you cut them when you should, those losers stay small and they stay where they should be. And if you focus all your mental energy on your winnings, that's where you have the highest probability of hitting those few home runs. And it just takes a few home runs to offset all of those small losses to become a profitable trader. And that's what we're going to focus on next week. So, a little bit of homework for you. I want you to go back and look through your trades over the last, call it a few months if you can, and look at, what's your account size? What does 2% look like for your account? How often have you exceeded that 2% rule? And what's been your largest loss so far? What's your biggest drawdown? And do some of that mental math. Say, based on my drawdown, how many wins did I need to get back to break even? How much did I have to return from a return perspective to get back to break even? And understand, where do you sit on that spectrum, right? This chart is really, where you want to understand, that death zone, this danger zone is where you want to stay away from. So look at your account and understand, where have you been? Have you been well into the red? Have you been in the blue? Have you been, into the red multiple times in the last year? the better you can answer those questions, the more information that you are going to have to change your behaviors and put you onto the path of profitability. Today's session is not a fun session. I'll be honest with you. It's not a sexy section. We don't talk about indicators. We don't talk about strategy. We don't talk about any of those things that are fun and interesting to dive into. But it is arguably the most important lesson to learn if your goal is to reach profitability, because without this, your chances of being profitable are virtually zero. So it is the most important one, but not a particularly fun one to talk about. Okay, good afternoon. Welcome back, everyone, to our third session in our series on why winning trades are not enough. In the first week, we covered why this is such an important topic to be focused on and learning about. Last week, we talked about managing downside so that we even have the capability and the opportunity to capture the upside. And this week, we're going to talk about probably the most interesting aspect of it, which is how to capture that upside, how to turn an account into a profitable account. And specifically, how do you take something from just raw ideas and turn it into a profitable trading account? Now, we're going to be talking about arguably what is the hardest part about trading. In all of the other sessions, the process that we've been teaching and talking about has been very black and white, uh, very very black and white and very objective. Today, we're going to be talking about something that's far more subjective and arguably, from my perspective as traders working with thousands of traders over the last 18 years, arguably the hardest thing to do, which is why I want to try to spend some time today, show you some analogies that I think are relevant to helping create the right mindset, and then going through as many examples to show you the data behind why you need to be doing this one thing that we'll be teaching during today's session. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. This is the third part in a four-part series. And during this session, we'll be going over the OptionsPlay platform. If you are new to OptionsPlay, you can sign up using the link here on your screen at new.optionsplay.com, which I will post into the chat window. But also, if you want to point your phone to that QR code, you can sign up for your free 14-day trial that will give you access to learning more about this process that we are focusing on during this series, the daily trade ideas and research that mimic the process that we are teaching you, and then also having access to the early breakout detector, which is the starting point of the ideas that these processes are driven off of. So all of that is included during our 14-day trial, which you can access with that QR code or the link on your screen. So with that, let's go ahead and get started. Let's just dive right into it. Adding to a winning trade is the hardest trade to make, but that is arguably the most important skill that you need to learn to turn ideas into profits. A lot of traders feel that in order to reach profitability, they need to have better ideas. They need to have better indicators, a better strategy. They need to subscribe to some type of expensive data feed like a Bloomberg terminal that they're not subscribed to yet. However, over my 18 years of working with traders, that is the single most important process that differentiates successful traders from everyone else is their ability to add further exposure to a trade that's working out. And there's a lot of reasons why this is arguably the hardest thing to do emotionally and psychologically speaking. Number one, it feels like chasing. If you buy a stock, let's say at 100, it runs up to 110. If you buying more at 110 feels like you're just chasing that specific move. You feel that the stock is already moved. What if I add more exposure and the stock turns against me? That's the biggest fear that we all have when it comes to adding more exposure, which is why we do almost the exact opposite. Every single time we buy a stock at 100, it goes up to 110. What do? We want to take profits. We want to reduce exposure. We want to collect our profits instead of doing the exact opposite, which is where the market has proven your thesis or your view to be correct. That's where you want to be investing more capital into. And I'll give you one analogy here in a couple of minutes that's going to help frame this perhaps in a different way that makes it more obvious as to why this is one of the most important skills to learn if your goal is to reach profitability, which I'm sure every single one of you watching today has that specific goal. Number two, it feels like you're adding more risk. Doubling the exposure, potentially even tripling the exposure in a single name sometimes might feel like that's being somewhat reckless. If anything, we here at OptionsPlay, myself or other places might have taught you about managing risk as being one of the most important aspects of trading. Adding more risk to a trade feels like that is going outside the bounds of what you have been taught. And I think the best way to alleviate that concern is to look at real examples of what adding to a trade looks like, even in the cases where it doesn't work out, and weigh it against when it does work out and see the difference between the two. Once you see the data, I think your mind will change with regards to the risk aspect of adding to a specific trade. And third of all, there's no story in it. You're already invested in that particular stock. A lot of times there's an emotional element of trading something new, a new opportunity that's come across your board, something that's emerging. And you always want to be in the new, hot, shiny thing. You don't want to stay invested in something that might have been yesterday's news. So there's a lot of reasons, psychologically speaking, adding to a trade that's already starting to work out. So meaning if you bought, and I'm just using shares as an example, but this applies to options as well. But if you buy a stock at 100 and the stock runs up to 110 or 120, our gut feeling isn't, our gut doesn't tell us buy more at 120. Our gut says take profits. How many of you can relate to that? When you buy a stock at 100, goes up to 120, what's your gut telling you to do? You want to take profits, not buy more at 120. How many of you can relate to that? If you can relate to that, type one into the chat window. And if you can relate to that and that's how you feel, that's perfectly normal. But that is where you need to start learning how to change that gut feeling into what you want to do versus what you should do in terms of reaching profitability. Okay. So I'm going to kind of frame this in a separate analogy that I've been using recently that I think is a really good analogy that kind of reframes this exact problem, right? And I go back to the example of imagine you're at Thanksgiving dinner and you've got two family members. Each of them have pitched you on a business that they're trying to start in the next year. And both of them have asked you to invest $10,000 in the business that they're starting. And a year later, you think both businesses are interesting opportunities. You invest $10,000 each in each business, and fast forward a year later at the next Thanksgiving dinner the next year, one business from one family member is thriving and doing incredibly well, and the other family member's business is really struggling. And both family members come back to you the next Thanksgiving and ask you to invest more in their businesses. Where do you want to invest your an additional $10,000 or more money in the business? Would you rather invest in the one that's doing incredibly well, or would you rather invest in the business that's really struggling and try to help bail that family member out? I think when you think about it from that perspective, the choice is fairly obvious, right? You probably want to invest, where do you have the best chance of investing more money and getting a better return on your capital? It's probably going to be in the business that's thriving, the one that's already growing, that's profitable, that's full of momentum. That's where you want to put in more money. That's where you're going to likely get your money back and more. On the other hand, if you decide that you're going to invest more money in that struggling business, well, your chances of getting your money back is probably much lower. And it's no different. when you think about a trade that's you put on one day. Fast forward a certain period of time, one trade is going well, one trade's not going well. Where do you want to put more of your exposure, in the one that's working or the one that's not working? I think a lot of that becomes a lot more obvious. And when it comes to trading, the decision is almost exactly the same decision. It's really not that different. And when you think about that, this is really where sometimes a light bulb goes off or something clicks in your mind, because a lot of times when traders are struggling, what they do is they spend all of their time, their emotional capital on focusing on their losing trades. How many of you can relate to that? Type two into the chat window if you seem to sweat most of your time looking at all of your losing trades when you open up your brokerage account in the morning and you think to yourself, what can I do to turn this losing trade around? Should I put more money into this losing trade? Maybe it'll turn back, right? And the classic example is you buy a stock at $100 that you think is cheap, and now the stock drops to 80. What do? Well, if you thought it was cheap at 100, it must be even cheaper at 80. Let me buy some more in hopes that if it comes back to 90, I'll get back to break even. And if it goes back to 100, I'll be profitable, right? That's the fallacy that we tell ourselves when a trade is not going the direction we expect it to. What we don't do is say, hey, you know what? That trade didn't really work out. Maybe I shouldn't be investing more money or throwing more money on a trade that's already not working, right? And I see a bunch of thumbs ups and people saying, that's definitely true. Where that's kind of what I did, right? I got emotionally invested and I kept investing more money in a trade that clearly wasn't working out, as opposed to putting my money into the places where I was right in the markets. And when you think of it that way, you start to shift your mindset. And that shift in mindset is arguably the most important indicator of whether or not you're going to be successful in trading or not. So last week we covered managing risk, right? Because there's no chance of upside if you don't manage your downside first. So that's first and foremost. But once you manage your downside, and that's a very black and white, very objective thing that you do every single day. So when you open up your trading account and you see those trades that are not working out, the rule of thumb is you need to cut those losers as quickly as possible. As the faster you can accept the fact that you are wrong on a trade, the better you're going to be off and the more time you'll be able to spend on your winning trades, because the amount of emotional capital and time that you need to spend on winning trades is going to be somewhat mentally draining, because how do you manage a winning trade is more of an art than a science. So it takes more time, it takes more effort, and that is where you need to reserve your limited mental capital to manage your winning trades. You don't want to spend all your mental capital managing your losing trades. That's not the place that you want to spend your time, because if you spend all your time and efforts thinking about your losers, expending all your mental energy on that aspect of your trading, when it comes to your winners, you're going to make the wrong decisions. You're going to be very counterproductive on your winning trades. That is the hard look that you have to do on that you have to work on yourself, with regards to where do you focus your time every single day, and how do you restructure your day to focus on the things that are actually going to generate profits for your account. Now, I'm going to show you all the data to help you back up all these things that I'm referring to. So let's just take a look at the hard numbers, right? We took a look at kind of some of our trade ideas over the last couple of months. And the first thing we looked at was, what if you just randomly pick stocks out of the S&P 500 over the last, couple of months, right? Arguably one of the strongest runs in the markets here. Even in what has been one of the strongest runs in the market over the last few months, if you just randomly pick stocks in the S&P 500, you basically had a coin flip. 50-50 chance, whether if you took a dartboard to the S&P 500, you had a 50% chance you're going to land on a winner, 50% chance you're going to end up on a losing trade. Now, that is trading the equity itself, right?
if you look at the ideas that we generated on Options Play, so this is looking at the technical ideas that are here in Options Play, right? Meaning if you looked at the stocks that generated a buy signal versus the sell signal on Options Play, that had an accuracy of about 56%. So a modest gain over what was going to be a kind of a 50-50 shot in the dark. And this is really where a lot of traders may be shocked at understanding, what do profitable strategies even look like? Because, I've been doing this for 18 years and I have probably back tested tens of thousands of different strategies over my time. Trying out almost every single possible technical indicator, relative strength indicator, volume indicator, fundamental indicator to kind of gain an edge. And the one thing that I've learned in my deep, deep bench of backtesting is that the best strategies will be usually somewhere in the 56 to 60% winning range. And just to put that into perspective, and I've talked about this a lot over the last few weeks, but put that into perspective. There's not a lot of other places in your professional or personal life where you could say, I am right 60% of the time and I'm at the top of my game. We've talked about this, there's probably the closest profession to have to this is probably baseball, where, you bat 300 and you're at the top of the game. You're at the top of your game. So to fail 7 out of 10 times, you're considered great at your job. Well, unfortunately, with trading, the trade ideas that have winning rates greater than 60% usually are so rare that those strategies are really not worth as being part of your core strategy, because any trade ideas that are right 60% of the time or more generate so few signals that you might only get one or two a year, which means that it can't be the core part of your strategy. Anything that generates signals on a daily and weekly basis usually will top out in the 56 to 60% range, which means that if you're in the top of your game, 4 out of 10 trades are going to be losing trades. And that's a really tough thing to mentally deal with, to be wrong 40% of the time and say, yep, I'm really good at what I do. There's just no other part of our lives where we can be wrong that often and feel good about it. And that's a big struggle that traders have. But that's the reality of trading. But here's the thing, right? With a 56% win rate, you can easily be a profitable trader. It's just a matter of the process that you apply to that 56% win rate that will generate those profits. And that's what we are here to help you teach during this 4-part series. That is what I want you to be able to walk away from, is how do you take ideas that are right 55, 60% of the time and turn them into a consistently profitable trading account for yourself. Now, the third number that I want to show you is that 56% of trades were right on the initial trade. So imagine brand new idea comes across your desk on trading signal. 56% of those will be winners. But out of those winners, some of them, out of those 56% of those trades, some of them will turn sorry, out of all the trades that you make, 56% of them will be winners, 44% of them will be losers. But what happens if once you have a winning trade, you start adding more exposure to that trade? Well, what we saw here, at least in our trading sample size, was that 68% of those additional trades ended up being winners as well. Meaning that the true edge comes from not from fresh ideas. The true edge comes from when you invest your money back into trades that are profitable. Because if you invest in money in trades, if you invest your capital in the trades that have already been profitable, you have a much higher chance of those trades being profitable than if you were to say, okay, let me take my profits and reinvest them in a brand new idea. Does that make sense? Investing in profitable trades already have a much higher chance of success than if you were to take profits and then invest those profits in a brand new idea. Does that make sense? Please type one into the chat window if that makes sense to you. And this one metric, going from being right 50-50 chance if you were shot in the dark to something with some, using technical indicators, using a strategy that gives you an edge, and then taking that edge and applying a process to it where you are investing your capital in trades that are starting to work out. that's when you can, and there are periods of time where this is much, much greater than 68%. We have seen periods of time where this is in excess of 80%, during strong periods of the market. And if you had looked at our daily play stats from just even a week ago, this was around 79%. The markets have pulled back a little bit, so some of those last winners that have pulled back, but the true edge really comes from investing in your winning trades, because that's really where you have the highest probability of having success in your subsequent trades, rather than saying, okay, I've got a winning trade. Let me take some profits, and then now let me trade a brand new trade. Because if you trade a brand new trade, you get right back to this 56% number, right? So that's where a lot of traders tend to struggle with trading, is that they take profits early because gut tells you that, I've made some money, I don't want to lose the money that I've made. And then you take those profits and you reinvest them in a brand new trade. So once you reinvest in a brand new trade, you reset to that 56% chance of being successful. And then on top of that, if you don't manage your downside, with discipline every single time, and you have a couple of trades that kind of slip, or you risk too much, the combination of those two things is what causes most traders to um, to to not be able to reach profitability. Okay, so let's take a look at some actual trade examples, because up until now we've been talking about adding to trades as a very theoretical and very academic exercise. So what I want to do is I want to go through a couple of real examples, trades that have worked out well, trades that have not worked out well, and then show you all the data so that you can really see what the difference looks like. And I think once you see some real examples, that's really where things start to click for most people. So the first one I want to take a look at is Alphabet. And, we have been incredibly bullish on Alphabet. It's been our top AI pick. So as soon as it generated a buy signal in our early breakout detector, which was on April 8th, we decided to go out there and start selling a put credit spread. And the idea with the early breakout detector is always when a stock is trending sideways and then starts to trade. I'm sorry, is trading in a downtrend and then starts to trade sideways and starts to make that initial move higher here. We want to catch it as early as possible. And I talked about this a little bit here on Monday for those of you that have joined me on Monday mornings, because the the ability to follow through and add more exposure on a winning trade, you have a better chance of doing it if your initial trade is as early as possible. So let's go through this example here, right? So we generated that initial early breakout signal here on the 8th. That's when we sent our first signal on Alphabet. And quickly, the trade started to work in our favor, meaning we were confirmed in our initial view that this early breakout was actually going to break out. So very quickly, within a week or so, on April 17th, Alphabet went from our early breakout detector into our confirmed outperformer list. And at that stage, once we got confirmation of that move, that's when we added to this exposure. So initially, we sold the put credit spread. Then we said, let's go out and buy a call debit spread. Once it got moved into that category of a confirmed outperformer. And then on the 29th, and keep in mind that we're only going to add exposure if previous trades are profitable. If a previous trade is not profitable and something, it generates a new signal, we don't use that as an opportunity to add. We only add when a previous trade is profitable. So we entered the trade on April 8th. That trade ended being profitable on 4/17 when it got confirmed or got upgraded to that confirmed outperformer. And then on the 29th, it generated another trend following buy signal. You can't see it here on this chart, but it had a little pullback here, and that little pullback was enough to generate that buy signal. And that's when we decided to enter a new trade. And the stock quickly popped in our favor, and it kept moving here. And then when it pulled back here to I think this was on June 2nd, if I'm not mistaken, this first trade had already expired, but the second and third trade were still live and those were profitable. When it pulled back here, we were basically taking this pullback as an opportunity to see if this gets further upside, right? And the last one didn't work out, but but what you have to look at is the totality of all of this, right? Over the period of time, we had four opportunities to continue to push one trade, one thesis that ended up being right. And this is how we turned, an initial trade that risked about $2,000 each on the specific trade into a $6,600 gain in our portfolio. And this is a classic example of pushing or adding to a winning trade. Um, so like I said, the best chance of you actually doing this is if you take the initial trade early on. And that's why the early breakout detector is a core piece of it. You can find the early breakout detector here on OptionsPlay. If you go to your watch list here, the first thing you're going to find on your watch list is the early breakout stocks. These are all the stocks that have met our early breakout detector. And I like to sort it based on relative strength, right? If you sort it based on relative strength, you'll see stocks like DoorDash, Roadblock. These are stocks that have recently just taken off here. So look at Roadblock, right? This is a stock that has clearly been on a very long downtrend here, and it's actually generated such a strong move here. This is actually technically still a bearish trend following trade because stocks that are like this, that have rallied tend to have these moves here to the downside. But from our perspective, look, this is the first time really that the trends have started to turn positive. Now, it did turn positive here. So this was potentially an early breakout detector signal here as well. But as you can see, it quickly reversed, right? So this is what we're saying here is that you can take this opportunity here. If it reverses, take a small loss, move on. But if it does really start to take off, your upside is huge, right? Look at what the upside is here for a trade like this. Now, if you want to try to capture a trade from 50 to 100, right, you have plenty of opportunities. So if you establish a small position now, and let's say it gets up to 60, 60 or so, right, 62, that's an opportunity to say, okay, I caught the move from 50 to 60. Let me add some more. And if this starts to work out here, it might reach 70 pretty quickly, maybe add some more. By the time it gets to 80 or 90, this is now in a confirmed uptrend. Now at this stage, everyone else is trying to get in, but you've already got in twice, right? And then maybe there's one final push to that 100, and that's really kind of what you're looking for. And if you do that, you've hit this huge home run on what was initially risking $2,000. So the early breakout detector is a big part of having kind of that mental capacity, that mental fortitude to add to a position, because if you're getting in at this stage, right, and you catch that move from this part to this part, will you have the mental fortitude to add at four? Maybe you might be saying to yourself, this stock went from 275 to 400. I'm not sure how much this can go from 400 to 450, right? But if you had gotten in at 300 and bought more at 340 and bought more at 350, buying more at 400, 380 is not that difficult because you're already, quite profitable from that first three, right? Or adding the second and third trade is not that difficult because you've seen this stock decline from, 400 or so down to 300. And this stock can maybe go back to 400. So you get in early, you have no problems adding at 2 to 3. So the early breakout detector is a really big part of being able to follow through on this. It's not as easy as just every single trade you have a winning trade, you add to it. But if you add to a winning trade that you got in early, you have a much better chance at following through on that. Does that make sense? Please type one into the chat window if that makes sense to you. Perfect. Okay, so let's take a look at another example that didn't go as well for us. And I think many of you that have followed us here at Options Play over the last month have brought this up, that Broadcom did not work out, right? But, a lot of times, even the trades that don't work out, you'll see are not nearly as bad as most people think, right? So this is a Broadcom, right? So this was also same thing, early breakout detector. We caught this relatively early on the move. I would say that I really wish that we had caught it a little bit earlier as well, but it just didn't trigger the thing until April 13th when the stock broke out here above that 350 level here. So that was our initial trade we got in, and then on May 1st, it generated another a buying opportunity here. At this stage, what we found was a really attractive put spread to sell again on May 1st. We did it again on the 3rd. And then by the time the fourth trade happened, this was right before that earnings announcement. And there was just a lot of momentum. There was a lot of relative strength. And this was when all the chip stocks were taking off on earnings. So we had the potential to hit a huge home run on this if it followed through with all of the other chip stocks where, on any decent news, chip stocks were going up 10, 20% on earnings. This could have been a huge winner, but instead the earnings announcement came out far worse than expected, and the stock dropped from, I think it was 470 or so back down to below 400 overnight. And you would think that a trade like this would be a disaster. And, by all means, this is a trade that didn't work out. But, you know, because we got in so early and we collected income from all of these trades, the net result on what was $8,000 of risk, right? $2,000 on each trade that we risked was only $3,000 to the downside. And what I tell in traders is that will I take this trade again if I was given the same setup? And the answer is 100%. I would take the exact same trade every single time because I would rather take on a $3,000 loss and set myself up for, what could be a six to $8,000 gain to the upside every single time. It's about the potential. It's not, I mean, not every trade's going to work out and you have to accept that. But what you have to do is you have to do the work to set yourself up for that upside. And the numbers speak for themselves, right? The winners, when you press those winners, significantly outweigh the losses, because when you are adding to a winning trade, your downside is going to be somewhat limited because you have the winning trade to offset any additional losses. Like I said, you never add to a trade unless it's already in a profitable trade to begin with, because that profitable trade will buffer the losses. So I will always set myself up and turn a winner back into a loser. I will accept the fact that I have $1,000, $2,000 in profits, and I would rather turn that back into a loser because it gave me the opportunity to hit that home run. And if you keep doing that every single time, the home runs will come. The losses will also come as well, but the wins will offset the losses at a margin of nearly 4-1. If you look at just the daily plays, the winning trades where we pressed those winners gained about $44,000. The losers lost about $10,000. That's a gain of about 4-1. So this is all coming from trade ideas that had an initial win rate of only 56%. A lot of traders think that if I just have better ideas, I'll be profitable. Guess what? Better ideas is not what makes you profitable. Better ideas maybe gets you from 50% win rates if you were to put a dart on a dartboard to maybe 60% if you have a really incredible strategy. And 60% winners, I will tell you, in itself is not enough to be profitable. This process can get you to profitability, even if your winners are only 56% initially correct, because these are the numbers from our daily play. We were only right initially on our trades 56% of the time. But in the few percentage of times that we were correct, we didn't just take profits and move on and get back to the 56% win rate. We invested in our capital in the trades that were profitable, and that is how you reach profitability. You focus on your winners, and every single time you get an opportunity to invest more in a winning trade, you always take that opportunity, because what that does is it sets yourself up for that home run. You're not always going to hit home runs, but if you always set yourself up to hit those home runs, when those home runs materialize, they will significantly outweigh when those home runs turn back into losses or when those potential home runs turn back into losses. But that is worth your time to do. Does that make sense, everyone? Please type two into the chat window if that makes sense to you. Someone asked a really great question is, don't you need a target? You absolutely need a target, okay? This is not to say that you just perpetually add to winning positions every single time. I tend to find that most of the time trades like this will top out at about four. When you add the fourth time, you may sometimes have tapped out, right? But Micron's a good example of this, right? And I have Micron here as a trade. Our actually most profitable trade was Micron, $8,000 in terms of Micron. But the last trade that we made on Micron was I think it was in the $680 range, right? We didn't capture that whole move. And part of that was because Micron was kind of a straight line up. It didn't really give us an opportunity to generate more signals because, our buy signals require the stock to take a bit of a pause or even a bit of a pullback in order to generate that buy signal. So if you look at Alphabet, right, even though you can't really see this, but on the when it generated that third signal, there was a small pullback here, and that small pullback is what we needed to kind of um, have any form of an edge in terms of our signals here. If you look at this fourth signal, right, this pullback was what gave us the signal to buy more, right? You want to buy on pullbacks, and when stocks go parabolic like SanDisk or Micron, a lot of times there just aren't even a deep enough pullback to justify that kind of risk. That's really where you're chasing. So the short answer to your question is yes, you need a target, and you also need a process for knowing when a stock has generated a trading signal. And this is also a tool that we have inside of our ideas platform, right? So inside of ideas, if you add all your positions into your portfolio here at OptionsPlay, you can actually select your portfolio and see all the positions that have generated a signal today. So for example, let's say you have 10 positions in your portfolio. If you have those positions inside of OptionsPlay, you can actually quickly scan how many of those positions have generated a new signal today. That is actually how I use OptionsPlay to decide when there's an opportunity to add more exposure to a trade, because I track all the positions inside of OptionsPlay, and when an existing position that's profitable generates a new buy signal, that's my opportunity to say, okay, let's add more, especially if it has not hit our ultimate target price. So if you look at Roadblocks, this is a good example here, right? This was a stock that was a $140 stock, in October of last year. So if I were to take an early a breakout signal here today, I would easily be able to say, maybe my upside target is 100, maybe not 140, maybe it's not going to get it back up to 140, but I would say maybe 100 would be a reasonable target to get back up to. So, from 52 to 100 is a long way to go, and there will be plenty potential opportunities for a small pullback where you can add more. And every single one of those opportunities that pulls back is an opportunity to add more, and you could maybe get the three, possibly even four trades up to that $100 level. And, guess what? Sometimes that trade just doesn't work out. And if it doesn't work out, you quickly get out, right? And that's it. You risk $2,000, you can get out of the trade and you move on. But if a trade does work out, and in some trades, maybe they get up to, maybe 75, 80, and they turn back around. Well, if they turn back around, chances are that will end up being, a trade that looks like this. It'll trade that'll look like this. You're down seven, eight, $900,000, maybe $2,000 in a trade that doesn't work out. Roadblocks was one of the trades that we took, right? It actually generated an early breakout detector. I think it was this particular trade right here in April, right? It generated our breakout detector. The setup looks almost identical to where where it is today. If you look at this chart here, right, the setup looks almost identical to where it was today. It looks like it was just about to break out here to the upside. If you look at the chart, if you look at this, the chart setup today looks very similar to what it looked like back here in mid-April. We took a shot. The trade didn't work out. We move on. But we keep taking shots. You have to keep taking shots, and you keep have to following through the same process. And you have to just understand that what is it? 4 out of 10 times, it's not going to work out, and that's okay. And if you can deal with that, you will be, um, you have a really strong shot at being profitable. And that's my goal here at Options Play is to take you on the journey, walk you through it, and then more importantly, actually show you how to do it every single day. So these daily play results that you're seeing here on your screen are the ones that we publish every single day here. And I've taken trades here from just the last couple of months, right? So most of you here viewing this today, if you're currently on a free trial, you've probably seen some of these trades. If you are a current subscriber, you probably have seen a lot of these trades over the last couple of months. These are the results of those trades. The numbers don't lie. You can see how when we press winners, those winners can go on to hit some home runs. And when they hit home runs, they outweigh the losers by a very significant margin. So if your goal is to reach profitability, this is how you do it. It's not about what indicators you use, where you get your ideas from, what data packages you subscribe to. None of that. Not that none of that stuff is important, but that is not what's going to make you profitable. And for many of you that have jumped from one subscription service to the next, to the next, to the next, for whatever service that promises you that we've got the secret sauce, if you just follow our strategy or our indicator or our way of doing things, you'll be profitable. Yet you have found that, as you jump from one subscription to the other, you have not reached profitability. Hopefully this is the answer that you've been searching for. And this is what we not only teach, but we implement every single day. So if you look at the daily play from today, 2 of the trades that we added during the daily play today were already existing winning positions. We added a trade in Robinhood, right? We just added Robinhood a couple of days ago when it was just starting to break out here. This was also a stock in our early breakout detector. It just generated our early breakout detector when it broke out above this $93 level here. And as soon as it broke above 100, that's just confirming our views, right? So, we kind of got in early when things were just starting to turn green. It was very early on, and we weren't sure if this was really going to take off or not, right? This easily could have just turned right back into where it was before because, we had a breakout here and then it quickly reversed. And when those happen, you move on, right? But here, it triggered our early breakout detector and then started to actually break out. And if that's the case, you add very quickly because, it could easily run up to 125. And if it runs up to 125, that could be the end of the trade. And that could be a really nice home run that we've already hit on this particular trade. GE is another example of this, right? We're now on our 4th GE trade. And GE, we got in early on in the early breakout detector. Also, when it was in this 311 range, right, we kind of got in. And as soon as it got up to that 325, we added more. And it got above 325, we added more. And when it got up to 350, we added more. And when it broke out to new 52-week highs. So we're on our 4th GE trade. And, GE is likely going to turn out to be one of our better trades. And the reality is that only about 10% of your trades will end up being these home runs, but those 10% of those trades will significantly outweigh the losing trades in your portfolio. Okay. So just to quickly talk about kind of some of the mechanics of adding exposure, I tend to find that most traders, especially when they're beginning at learning this, you stick to a flat, fixed exposure add, meaning you initially deploy 2% of your account on the initial trade. On each subsequent trade, you just add another 2%. So let's say you get a second opportunity, a third opportunity, maybe even a fourth opportunity. Each time you do that, you just add 2% exposure. If you look at kind of some of the more experienced, more successful traders, they usually deploy more of an exponential growth curve. They'll initially deploy only 1% on an exploratory position. They're just trying to test the water, see if it works out. If it starts to work out, they quickly scale up. They go from 1% to 3%, which is the same as the net result of the first two trades, but they go from 1 to 3. So they're risking smaller percentages initially. So if it doesn't work out, they're actually losing a smaller percentage of their portfolio. If it does work out, they're quickly scaling themselves up to kind of a similar position as the fixed. And then if it does really take off here, a lot of times they'll add, even more, maybe 5%. So within 3 ads, they're at roughly the same exposure level as you might be, on 4 ads, but they're doing it much, much quicker. They're taking more of an exponential approach. So those are two different approaches. I tend to find that if you're starting out, just from a mental perspective, stick with the fixed one. But if you start to see results and you're starting to see more confidence in this, in doing this, you might want to consider something similar to like this. It doesn't have to be exactly 135. It could be 123. It could be 125. But scaling up in a more exponential pace just gets you into the trades, a sizable part. It sizes up your trade earlier so that you can capture more of that move. So you get more of that explosive exponential move in your trades. Very similar concept, um, uh, just I tend to find that beginners struggle with the exponential move. All of the results that I've shown you today were based on assuming a flat fixed, because again, I'm assuming that most of you that are starting out would take on a flat fixed method versus the scaling up method. There are many of you here watching today that have been learning this process with me over the last few months, that you might feel that you are up for something that's more advanced. And that's why I do have the scale up method here as well for you to watch. So just to recap what we've discussed here today, what you want to do is you want to find that confirmation once a trade is working out, and you want to add to that position. You might want to change your strike prices. Well, you do want to change your strike prices, but you generally want to size up at least another 2% of your account on the ad, and then make sure that on trades that you are not working out, you set those stops and you move on from those trades. So what I want you to do for next week is look at your portfolio, pick a winning position, and look through all the winning positions every single day and see which ones have generated a new buy signal. That's going to be your homework, is that instead of taking profits on that trade, look at adding some further exposure. And this is a part that's going to, the first few times you do it, it's going to feel incredibly unnatural. It's going to feel like it's going against every grain in your body to do so. But this is the work that we need to do to reach profitability. And that is what I am here to help you do week in and week out, and show you how to do it day in and day out through the daily play trades. So if you read the write-up in the daily plays, I highlight what the trade is, whether or not it is adding to a specific trade. So, in this Robinhood example, I told you that we're pressing our winner from our June 16th trade. In the Pepsi trade, we currently have 2 winning trades already. We have one from May 11th, one from May 15th. Both of those are up in that particular trade, and we're adding more to a bearish trade, right? So the explanations are there. I'm here to teach this to you. I'm also here in the trenches every single day to give you real examples that you can follow with, so that if you're kind of new to this and you're trying to figure out how to do this, I'm showing you how to do this every single day through that daily play. So with that covers what we want to discuss with you here today. Like I said, if you are brand new to OptionsPlay and you want access to the early breakout detector so you can find trading signals that you can get and enter early on, that you have the best shot of adding further exposure to, you want access to the daily plays where I'm showing you how to do this every single day with trading examples on a daily basis, multiple examples on a daily basis. This is all available to you with a 14-day free trial at new.optionsplay.com, which I will post this link into the chat window, or you can point your phone to that QR code here on your screen, and that will give you access to all of that here at OptionsPlay, including this entire series that you can review with the slides, the recordings, and just take your time and make sure that you follow through with every single step of this process. It's really not a difficult process. It's just a process that takes time to internalize. Once you internalize it, once it becomes second nature, excuse me, you'll see the success of it fairly quickly. So adding to winners will win more often and it pays more per trade. And every single time your gut tells you to fund that losing trade, think about the data. The data shows you that it is significantly better to be spending your time on focusing on your winners and don't spend a single moment more on your losing trades. With that, that covers what I wanted to share with you here today.
Okay, welcome back everyone to our fourth session in our Growth Lab series of why winning trades are not enough. Now, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today what we're going to be focusing on is a review of what we've gone over the last 3 weeks. Essentially, our focus here at OptionsPlay is always on how to focus on profitability and specifically the process that has been proven to help drive profitability for traders. Something I've been teaching for many, many years, but is arguably one of the most important yet hardest things to learn from investors. Everyone wants to learn about specific technical indicators or strategies or data points, but what's hardest to learn is changing your mindset, changing how you think, changing how you manage your emotions when it comes to trading. But those are the things that you need to change if your goal is to reach profitability. And that's what we've discussed over the last 3 weeks. So today what we're going to do is we're going to be reviewing the multiple steps that are required to reach profitability, how each one you should approach it, and a summary of the tools that are available to you here at OptionsPlay that can help you shift that mindset and shift the way you think and the way you react to your trades so that you can start moving yourself onto that path of profitability. Now, like I said, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Now, if you're new to OptionsPlay, you can sign up for a free trial at the link on your screen, which I just posted into the chat window, or you can point your phone to the QR code on your screen. That's going to give you access to the platform that we'll be using during today's session. It'll also give you access to the early breakout detector that we are going to be reviewing during today's session. We'll be actually doing a deep dive into the early breakout detector next time. But today what we're going to do is we're going to focus our attention on the rules for the profitability playbook. So what we've learned over the last few weeks are a series of habits that you need to shift if your goal is to reach profitability. And what I want to do today is review it and show you how you can turn those into rules. The first thing that we went over now going 4 weeks ago was just a reality check as to what profitable trading looks like. And the reason that I did that was because it's become clear to me that that profitable trading has been sold to a lot of investors through advertisements and subscription services that promise that if you just listen to me or follow my strategy or use these specific set of indicators, you'll be a profitable trader. And that somehow profitable trading is something that if you just apply some secret strategy that you don't have access today or some secret indicator that you don't have access to, you're just going to see these consistent profits week after week, month after month. And that's just unfortunately not even close to what the reality of profitable trading looks like. And the faster you can wrap your head around that, the more likely you are to shift the way you think, because the reality of trading is that even some of the best traders are effectively wrong on the ideas that they have around at least 30 to 40% of the time. And it's really difficult to wrap your head around how you can be really good at what you do and then still be wrong 30 to 40% of the time. Meaning 30 to 40% of the time you have an idea in the market, sometimes even as high as 45%, those ideas just turn out to be incorrect. There's not many other parts of our lives where we are wrong that often and still consider ourselves to be fairly good at what we're doing. And the faster you can recognize that, the faster your mindset will also shift, because you won't let the losses and you won't let the times when the trade doesn't go in the direction you expect to get to you mentally speaking. It is something that traders struggle with a lot, is the mental capacity to deal with wins and losses. So the reality of trading is that the vast majority of your trades will result in what I call small wins and small losses. These are trades that don't really go anywhere, and they either trigger a take profit rule and that's it. It doesn't really go anywhere beyond that. Or it triggers a stop loss rule and just simply ends at that. And those types of trades, and those could be as many as 60 to, perhaps 50 to 60% of your trades, where they essentially wash out. The gains and the losses sort of net each other out to effectively zero. The other 20, 30% of your trades will be losses, meaning just trades that don't work out. And then you will have a series of winning trades. If you use the right process, about 10% of your trades that go on to hitting home runs. And what you really need to make sure is that those home runs outweigh the trades that end up being losses. And we'll kind of go through the math, and we went through the math here last week to really show you kind of the breakdown of a profitable portfolio and how that all works out. So the first thing that we need to understand is that the reality of trading is many times very different than what a promise that we've been sold. And the faster you can wrap your head around that, the faster you will be able to recognize when a trade is not going in the direction you expect it to, and allow that to happen and simply just move on to the next trade. The faster you can do that, the more mental capacity you'll have to be focusing on what is the most important thing for your portfolio, which is how you manage your winners. That's really where you should be spending the vast majority of your time. However, we find that most traders never even get there, because most traders spend most of their time managing their losers. This is really where a lot of traders spend, the vast majority of their mental capital, is thinking if somehow they can just turn their losers back into winners, they'll be profitable in trading. But the reality, again, like I said, you can expect upwards of 40 to 50% of your 45% of your trades, sometimes even as high as 50% of your trades, to be just the ideas don't work out. And that's okay. That's the reality of trading. But like I said, there's not many other parts of your life where you can be incorrect that often and still consider yourself to be really good at what you do. And we really have a tough time as traders mentally wrapping our heads around that. I mean, how many of you can relate to that? Please type one into the chat window where you feel like you're just incorrect in your ideas so often. And you ask yourself, how is it possible that you can trade and be wrong that often? And unfortunately, that's just the reality of trading. And, there's not a lot of great analogies in other parts of your life where you can be wrong that often and still be good at what you do. We've kind of explored a few different analogies, and the closest one that we can kind of come up with is baseball, right? Some of you are familiar with baseball, and some of you are familiar with it intimately enough to know, a batting average of, maybe 350 is considered incredibly good batting average. That means that you're essentially only successful in 3 out of 10, or call it 3 out of 10 tries, and you're considered good at your as a baseball player. That means 7 out of 10 times you try to do something, you fail at it. But that's the reality of being a baseball player. And trading is actually not that different. And there's not a lot of other places in our lives where we're wrong that often and consider ourselves good at what we do. So we really have a tough time mentally just accepting the fact that we could be wrong 45% of the time and just be okay with it. But the faster you can accept that reality, the less time you'll spend on managing your losers, and the more time you spend on focusing the most important thing, which is arguably the hardest thing to do, which is pressing your winners. That means as soon as you have a winning trade, not doing what is the gut reaction, which is taking profits, but actually adding further exposure. So if you buy a stock at 100 and goes from 100 to 105, instead of wanting to take profits, you say, I want to buy more because the market has proven my views to be correct. The hardest thing to do, and it's not an art, it's not a science, it's an art, and that's why it requires our mental capital to do so. And the only way that we'll be able to do it well is if we protect our mental capital and focus 90% of our time on managing our winning trades. And that is the mental shift that we need to make if we want to reach profitability. So we'll discuss a few things today that is going to solidify these things as rules for us so that we can move ourselves towards profitability. And what I'm going to address is that last part first, the ability to press winners, because this is really where most traders struggle in terms of doing so, is to build the confidence to be able to do the exact opposite of everything that our body is telling us to do, which is once you buy a stock at 100, it goes up to 110. Everything in our body tells us take profits, don't let it run, because if you let it run, potentially the stock can turn back and we can turn back into a loss. And we as human beings we perceive that as much more painful than a loss right out of the gate. So how do you have the confidence to buy the stock at 100 when it goes up to 110, instead of taking profits, buy more? And then when it goes from 110 to 120, buy even more. And then when it goes from 120 to 130, and buy potentially even more. Everything in our body tells us to do the exact opposite of take our profits and run. But the reality of profitable trading requires us to have the confidence to be able to do that. And the only way to really have that confidence is if you're able to catch a trend early on in its life cycle. So the earlier you can catch a trend, the more likely you'll have, number one, multiple opportunities to add to that exposure before you sort of reach the peak where you could potentially take profit on that particular trade. If you are trading stocks after the trend has already started or well into a specific trend, we tend to find that it's much harder to press winning trades when you're already buying near the top. If you're buying at this number 4, trying to buy again at number 5, and then maybe having the market reverse lower is really what we're most concerned about. That prevents most of us from adding more exposure when the trade has proven their views to be correct. What we really need to do is be able to purchase something as early as possible so that we do have a few more opportunities to enter before we feel that this stock is overextended and has reached its peak or reached its full valuation, and that there is a harder justification to continue buying more of it. And what we will talk about here today is the different tools here at OptionsPlay that help you identify stocks at at this point number one, as opposed to looking at two, three, or four. How you can find ideas that are focused on these early breakouts, because that is a key part in being able to follow through with this one rule. It's easy to state this rule, it's much harder actually to do it. So it requires a specific set of ideas or specific set of signals that give you the confidence to do so. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. So, just to review what we've discussed here so far. Number one, what we want to do is we want to catch ideas as early as possible. The earlier you can find it, the more likely you are going to be following through with the rest of the rules. Number two is you want to cut losses cold, meaning you want to set your stop losses before you get into a trade. You have to size those trades correctly, because if you size your trades too large, you will have a tough time cutting losses when you should. And that when it comes time to cutting losses, it should be a mechanical black and white decision. It should not require any mental thought as to whether or not it is time to cut your losses and move on. And like I said, the faster you can accept that, perhaps 40 to 40% of your trades are just going to end up being losers, the more likely that you will get to that point quickly where you will have just the confidence to say, this trade didn't work out. Let me take a small loss and let me move on. So two things. You need to make sure that those losses are small, and you need to make sure it's a mechanical rule that you have set up before you get into the trade, that as soon as it triggers, you just let it go and you move on. And if you do those things, what that will give you is the mental capacity and the space to be able to focus on the few trades in your portfolio that are starting to work out. We'll go through some examples of our daily plays recently that have done that, and allow you to find opportunities as trades work out to do the opposite of what your body is telling you to do, which is take profits. And what you're going to do is you're going to start exploring how to take a trade that's starting to work out, and instead of taking profits, add more exposure to that specific trade. Okay, so the key part of all of this is the early breakout detector. It's the tool within OptionsPlay that we have been publishing on Mondays and Thursdays for many months now, and we've actually going back multiple years now, where we publish trade ideas that are part of this early breakout detector. But recently what we started doing is we started publishing it on the OptionsPlay platform, so that you don't have to wait for those Monday and Thursday equity research reports to find out what stocks are in that early breakout detector. You actually have that list in your OptionsPlay platform every single day. And more importantly, by having it in your platform, what we do is we allow you to rank the early breakout detector names by relative strength. And what that allows you to do is to classify which ones are the earliest and which ones are very late stage in terms of that breakout. So for example, if we go to our OptionsPlay platform right now, we have 60 names in that early breakout detector. And if you sort it by relative strength, the ones with the scores of 2 are the ones that are earliest on in their breakouts. So if we take a look at a stock like Booking, or let's look at DoorDash, for example. I'm just want to pick stocks of, stocks that we're all sort of familiar with, right? Look at DoorDash. This is a stock that was peaked at 283, traded all the way down to 150, essentially cut in half in terms of the stock. And over the last, call it 3 months or so, it's been forming this bottom here around this 150 or so. Let me actually zoom in a little bit so that it's easier to see. You see, this is a stock that was, 280, has traded all the way down to roughly 150, and over the last 3 months has been forming this base at 150. Multiple times this 150 level has managed to hold as support. So now it looks like the trend is starting to turn back. Look at the trend quality here. It's starting to improve. What was all red trends have now turned to 1 month bullish, 6 month neutral. And it has the potential here of of making a big move here to the upside. Now, here's the thing, is that do we know for a fact that this will make it all the way back up to 250, 275? The answer is no. No one knows. No one has a crystal ball. But what we're trying to do is find setups that are early as possible, take a small position in it today. If it doesn't work out, we cut those losses and we move on. That's it. But if it does start to work out, that's when we want to start. Instead of maybe when it gets up to 200, if the stock gets up to 200, we don't want to take profits there. We have a lot more potential to go here. Once it goes from 179 to 200, maybe we want to start taking a look at adding some more exposure. A lot of times you'll find a little bit of a pullback gives you that opportunity to add some exposure. Maybe it gets up to the 210s or so. That might give you another opportunity to add some exposure. Only about 10% of the time will the stock make this kind of big move here to the upside. But that's all you need is one out of maybe 10 opportunities like this that do end up taking off. And if those happen, you want to make sure that you try to capture an outsized gain from those types of trades. And I'll give you lots of examples of trades that we've done that did exactly this, and plenty of examples that stocks didn't do that. And it's okay. The math ends up working itself out where a few of these that you end up hitting home runs on will significantly outweigh a large number of losses in your account that just don't work out that way. However, what most of us do many times is we'll take a trade like this. When it gets to 200, what do? We take profits and we say, okay, you can't go broke taking profits. And then what happens is occasionally that stock continues to move higher, goes up to 275, and we don't capture any of it. And that is how we underperform in a portfolio. So the early breakout detector is really key in helping you find this. Now, just to show you, if let's say you chose a stock that has a relative strength of let's say 9 or 10, let's look at John Deere. You'll see that the chart looks very different. So John Deere technically is in an early breakout, right? This stock has been trading range bound for nearly 6 months or so, but basically since February. So this was a big move up from kind of 450 to 600, and now the stock has been trading sideways, and now it's very early on in its breakout. So technically, it's in an early breakout. But as you can see, it's a vastly different trading, trying to trade this breakout. Maybe it gets up to, all-time highs at 675 and then breaks out again further from there. But I would say the chances of that happening are just a little bit lower. It's not that it can't be a candidate for early breakouts, but I find that a lot of early, especially if this is a relatively new concept for you, the earlier you catch on to a trend, the more likely you will have the confidence to do so. Only if you have a more experience trading these types of strategies will you be able to take on, trades that have a higher relative strength. So the early breakout detector on OptionsPlay, sorted by relative strength, is the key part in helping you scan for opportunities that will give you the highest opportunity to follow through with this specific method. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. So you can find that under watch list. It's the first watch list that we have here listed in our global watch list. We have early breakout, building outperformance, confirmed outperformance. This is something that I go over every Monday morning during our market outlook sessions and our trade idea sessions, where I kind of give you an overview of the different type of stocks that are being triggered by these specific scans. And I usually pick out a handful of stocks to give you as a sample to help you start your week. But this is a scan that you can access every single day yourself using OptionsPlay. This is updated every single day on your OptionsPlay platform so that you can find these opportunities yourself. And if you sort the watch list based on relative strength, that's how you're going to be able to have the confidence to find the stocks that are early on in that breakout. Okay. So cutting losses. I saw a couple of comments about, the mechanical side of cutting losses here. And, this is really where this is the part of trading, like I said, that I find most traders that struggle with trading spend the vast majority of their time, their energy, their efforts on somehow hoping that if they could just turn their losing trades around, that they will be a profitable trader. But I can't stress enough how that just unfortunately isn't the case. This is really the part where you should be spending the least amount of your time on managing losing trades. Losing trades are the market essentially telling you that your views are incorrect, and that is not where you want to be spending your time, any mental energy or time, because the rules for cutting losses are black and white. It should not require any mental energy on your part to do so. However, I will say the ability to manage or to follow through with this specific rule lies in sizing your trades correctly to begin with. We always recommend that when you enter the trade on any options trade, you don't want to risk more than 2% of your entire account value as the max risk of an options strategy. And the reason for this is so that you can, down the line, manage the losses without sweating it. Because if you risk too big of your portfolio, that's where what poker players call pot committed, where essentially we have too much money on the line. We can't afford to lose. And when we can't afford to lose, that's when we start spending all of our mental energy and time focusing on that loser, watching the markets, hoping that somehow there's going to be some magic news event or indicator that tells us that this is going to start turning back around, and we start watching that position like a hawk, and we waste all of our mental energy focusing on our losing trades instead of focusing where we should be focused on, which is our winning trades. So the only way that you have any shot at following through with this rule is sizing your trades appropriately by keeping them small. The smaller the trade, the more likely you're going to just let it go and move on to the next trade. We always set our stop losses on our entry. So if you have a brokerage account that allows you to set an OCO order, this is one way that you can sort of automate that. Most brokerage firms will at the very least allow you to set a single order on a complex option strategy. So if that is the case, you trade at a broker that only allows you to trade with, set one order, then I would say the one order to set is going to be your stop loss order. You want to automate that part so that you don't have to think about it. You don't have to decide, at any one point, should I cut losses or move on? Because those should be set. And if you look at every single daily play we publish, we give you that stop loss level. This gives you a level that you can set when you get into the trade. So you essentially can set, I wouldn't say set and forget, but it gives you that opportunity to say that you don't have to make that decision as to when you cut your losses. The stop loss order will be able to do that for you. And when it hits, let it go and move on. You never average down. You never move the stops in hopes that, the stock will come back. And there's really no decision to agonize over. You just move on and that's it. And like I said, this is where I find a lot of traders have a tough time getting over this hump. And like I said, the advice that I have for you, if you're struggling with this part, and someone here in the chat window, John, is saying this is the hardest part. I completely understand. For many, many years, this is the part that I struggled with, and I'm sure most of you, if not all of you, struggle with on a daily basis. And it's not something that you learn once and you just move on. Like, this is a continuous learning process, day in and day out, as traders, to focus your attention on what is the important part, which is cutting losses. And I can't tell you enough how not managing your losses is what comes back to bite most traders, because the math of a loss is really tough to get around, or you can't get around. Because if you blow a 50% hole in your portfolio, you now need 100% gain just to get back to break even. So, which is why we generally recommend that you never allow a trade, a portfolio to draw down ever more than 25 to 30% because the math is just unforgiving once you get beyond that level that you really can't get yourself even back to break even once you blow a 25, 30% hole in your portfolio. So the only defense against that is to keep your losses small and cut your losses when you should. Don't ever double down, don't ever move your stop losses because as soon as you go down that slippery slope, that's when you start seeing bigger losses than you should or bigger losses than you expect. And then once those start to happen, that's really where game over. There is no upside once you blow a big hole in your portfolio. So the first thing you need to do is protect your downside. And the only way to do that is if you keep things small to begin with. That's going to allow you to have the best shot at following through with this rule and protecting your mental capital for what is the most important part of your day, which is looking at the few positions where the market has proven your views to be correct, and that is how you manage those trades. So the rules for adding to a winning position is that number one, the position has to be in the green. You never add to a position that's currently losing in its trade. So for example, if you look at all the examples over the last call it few months in the daily play where we call out every single time we add to a winning position, it's always a position that is currently in the positive, in the green that we add to. We never add to a losing position. That's number one. Number two, we add when there's a new signal that fires on that specific position. So this is one thing that you can use the OptionsPlay platform for because when you can sort all the trade ideas in OptionsPlay by stocks that are in your portfolio. So if you're managing your portfolio through the OptionsPlay platform, meaning you're entering your options trades into OptionsPlay portfolio, you can quickly, on the click of a single button, take all the trade ideas of our platform today and filter it down just to the positions that you just on the stocks that you have a position on. And this gives you a very quick review at the start of your day to say, are there any stocks in my portfolio that have generated a new signal today? That's your starting point to decide, is there an opportunity for me to potentially add more to a winning position? Like I said, only about probably 10% of your positions will fall into this particular category where you have a position that's in the green, right? So that's a trade that you initially put on at some time in the past that is clearly starting to work out and has now generated a new signal. So let's say you bought a stock at 100, it's now trading at 110, pulls back a little bit to 108, fires off a new trend following signal. That's an opportunity now, instead of taking profits, to add more exposure in that particular trade. Maybe that trade goes up to 120, maybe it goes back to 100. We don't know what's going to happen. But if every single time you have the opportunity to add more exposure to that winning trade, you're going to see how the math starts to work out in your favor because everything in our body tells us to do the exact opposite. And when you do get that new signal that fires, you want to reset the structure, meaning pretend that you don't have a winning trade in that stock today. How would you approach the structure of the trade, the expiration date, the strike price? And that is really where you want to be able to use kind of a clean slate. Pretend that you don't have a winning position. Reset the strikes, reset the expiration date, reset the trade, and you kind of manage each trade separately, but they're all part of one idea. But there will be one, two, three, potentially four separate trades from each other that you manage each one individually. And this is really where like I said, this is where you want to spend 90% of your mental capacity managing. 10% of those trades will end up potentially being home runs, and it's going to take time to manage 2, 3, potentially 4 winning trades. And because they're 4 separate trades, even though they're one idea. And that is really where it takes most of your mental energy. And that's what you want to save your mental energy and capacity for. Now, how do you add to this? I tend to find that as a beginner, you start with a fixed size. You start your initial position with 2%. When you have that new signal fire, you add another 2%. If you find another signal that fires, you add another 2%. And this is the method that we follow during the daily play process because this is what mass majority of traders who are currently struggling with profitability need to move themselves towards. We tend to find that as you get more experience with this, as you feel more confident in this, as you're seeing that profitability show up in your portfolio, we tend to find traders will move to something more exponential. They'll start with a smaller position, maybe only 1%, but quickly ramp that up to 3% once the position starts to work in their favor, and if they have an opportunity to add a third or potentially fourth trade, they're scaling up that trade exponentially. It essentially does the same thing, but it allows you to get into bigger size quicker this way, rather than taking a slightly longer path to get to 8% or so in your portfolio. You need kind of four opportunities to add 2% each to get to that 8% position. With an exponential rule, in two potential ads, you've now gotten to 9%, positions. So you're just kind of scaling up your size quicker and getting into the size that you kind of really want on a trade faster. But I would say for most people who are just starting out with this, pick the fixed size. It's just easy to do that mental math on the fly, because it takes mental capacity to do it, and you want to reduce the number of decisions that you have to make as much as possible. So having a fixed size every single time makes it a little easier to follow through on something that's unnatural. And then once you get a hang of it, once you get more experience with it, once you have confidence in it, you might want to move to more exponential sizing so that you scale up relatively quickly. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, so just one more example. We went through a bunch of examples here last week, but a prime example of one that we just recently added to very recently was GE. We managed to catch this trade fairly early on 5/28, May 28th. It triggered our early breakout detector. We published it as one of our equity research reports. So that's what the Monday and Thursday equity research reports that go out give you a sample of the stocks that are in this specific category of these early breakout trade opportunities. So we added the first trade on May 28th, and that's kind of when the stock, after trading sideways, first started to break out here in our early breakout detector. So we sold a put spread here initially to get into the trade. And then we had an opportunity a couple of weeks later, as soon as it started to prove out that this breakout was holding and starting to move higher here. As soon as it generated another buy signal, we added more to it. And then it actually generated another breakout detector here on June 12th, and that's when we added that debit spread because it broke out, initially around that 310 level here, but then it kind of traded sideways a little bit and traded against that 330 level and broke out above 330. That's when we bought that debit spread, and then when it finally broke out to new 52-week highs, when it reached around 352, we added even more. So this is a good example of a trade where, based on that early breakout detector, we got into a trend relatively early, and as it fired off multiple signals throughout the month, we were able to add more trades to that specific stock, where, the last couple of trades are still very much still very much in play and still have some upside left. And even though there's still upside left, we're up around $4,600 on this one trade in GE. This is the most recent example of a successful trade that followed through. Only 10% of our setups will end up being like this. The vast majority of our trades won't be like this. The vast majority of the trades might go up to 2 and then never fire really off a signal and maybe start fizzling down, right? Or just right out of the gate, just turns right back, below. And that's going to be the vast majority of your trades. And you just have to accept that. You just have to accept that the vast majority of your trades might hit a take profit and never fire off another signal, or cut your hit a stop loss and you move on. And those trades will largely net themselves out. 40, 50, maybe even 60% of your trades will fall into that particular category. Those are the trades that you don't want to spend too much of your mental capacity on. Only about 10% of your trades will take off and continue to move on like this. And that is where you need to have that spare mental capital to be able to deal with how do you manage these types of trades. It's because it is going to take a lot of mental effort to do so. And the only way that you're going to have that mental capacity to deal with that is if you don't spend all your time managing your losing trades and focusing on things that are not that important for your portfolio. So the math here starts to be very clear. Just this one GE example I'm showing you, we had about $4,600 of gains in that one trade. If you look at kind of all of our trades where we take a fixed percentage of 2%, right? We're always working with a hypothetical portfolio around $100,000. If we're risking 2% of our account per trade, our average losing trade is around $1,050 because we usually put a 50% stop loss on all of our trades. So our average losing trade is around $1,000 using that 2% rule. And a single trade that works like this, like GE, will offset, usually 4 to 5 losing trades in a row. And this is really how we reach profitability. We don't need many of these home runs to offset a large number of stop losses. And the only way that that math continues to work out is if we don't take profits early, that we keep pressing winning trades that do, take off, and that we stick to our rules when we manage our losers. If you can do both sides, that's when we have the opportunity of turning profitable. And if you look at our daily plays, the results speak for themselves. When we are able to press our winners, those added up to around $44,000 in gains over the last few months, while our losers netted around $10,000 in losses. And those two will offset each other significantly to reach profitability for your trading accounts. So not only are we here to teach you this process, which arguably is very academic and very conceptual, we are actually showing you how to do it every single day through the daily play portfolio. We're telling you when we have a profitable position and we're adding to it. And we're showing you exactly when we're doing that. And today's daily play is a good example of this, where we have a winning position in Royal Caribbean and a winning position in Assignment Property Group. Those are recent established positions in the last a week or two. And as those trades have turned profitable, we're adding to those specific trades. It's not easy to do, but it's really where we are not only teaching you this on Thursdays, we're actually giving you the trading signals every single day to show you how to implement this in a practical environment using the early breakout detector trades or ideas in our platform as the ideas that seed the daily play, and then following through with them as they play out. That is how we get to that that is how we get to that process of reaching profitability. So just to summarize, which I feel like we've done multiple times here, catch a trend early, do it using the early breakout detector that you have access to here at OptionsPlay. Make sure you size those trades appropriately and set your stop losses as soon as you get into the trade so that they become something that you don't have to manage on a daily basis. And then focus all your attention on the few trades where the market has proven your views to be correct, because that is where you're going to need your mental capacity to do everything to work against your gut or work against what your brain is telling you to do, which is take your profits and move on by pressing your winners, adding to winning positions. And where the market has confirmed your views to be correct. It's not easy to do, but that is where you need to focus your work on. And if you can do that, that is where you have the best shot at reaching profitability. where you don't want to be spending your time focusing all your attention, which is what a lot of a lot of you have been sold on this, through marketing over the last, few years or maybe a few decades, is just, if you buy my secret indicator, that's how you're gonna end up being profitable. Look at this, how this one indicator is right 70% of the time. And if you just have access to the secret indicator, you'll be profitable. How many of you have bought into those courses or indicators or subscription services saying that if you just follow this specific system or this specific indicator, you'll be profitable, only to do it and still not find yourself reaching profitability? Because even if you have a really successful indicator, you still need to follow through a process like what I'm showing you here today to reach that profitability. So I'm not knocking any subscription services that you might have or any courses that you might have purchased that have what is arguably what could be a great trading system or a great indicator. But indicators and trading systems and subscription services are not enough to reach profitability. And I'm sure many of you that have struggled for many years have come to that realization. So I encourage you to learn those other strategies and those indicators and those subscription services and those courses that you have taken. But what you need to do is take those things and apply the strategy or the process that I've taught you here during this series, to take those indicators and those strategies and turn it into a profitable trading system. Those are two separate things. So they're not mutually exclusive. And I really think that, many of you have learned a wealth of knowledge from different courses or subscription services that you might have access to, either currently or in the past. What you can do is you can take those lessons, take those indicators, take those strategies, bring them to OptionsPlay, and we'll show you how to take those strategies and turn it into a profitable trading account. That is the process that we are focused on here at OptionsPlay. And I really am thankful for all of you that are members that support us and allow us to continue to help you through this journey, because it is a journey. It is a learning process that many times takes months, if not years, to really get through. And the faster you can wrap your head around this, the more likely you're going to be able to take that indicator or strategy that you've already learned and turn it into a profitable trading account for yourself. Because I know many of you are struggling with that. I know that's why many of you are here watching the session here today. And that is my job here at OptionsPlay, is to walk you through that journey and hold your hand on a daily basis through that daily play trading signal that we send out, to walk you and remind you on a daily basis what it takes to manage your account to reach profitability. Okay, so like I said, if you are new to OptionsPlay, point your phone to that QR code on your screen, or use the link here, which I just posted into the chat window. It will give you access to our early breakout detector that we showed you here today. I'm actually going to do a deep dive on the early breakout detector here next time. And just a bit of housekeeping. Next week is going to be July 2nd, the day before the markets are closed for the July 4th long weekend. So I will not be hosting a Growth Lab series next Thursday during the start of a long weekend. So we'll be resuming this series the following Thursday. I will be back here next Monday to walk through a trade ideas and market outlook session. So we'll still meet up next week, but not next Thursday. Just a little bit of housekeeping. And we'll start up the educational session the week after on I think it's July 9th, is when we'll resume this Thursday education series, where we'll be kind of going over a brand new month of ideas that we have here at OptionsPlay. And that's really where you're going to see some new features inside of OptionsPlay in 2 weeks from now. There's some new stuff that's coming out here at OptionsPlay in the next couple of weeks that I'm really excited about, that we've been giving you some preview for.